here and I look at the report, now I see that's where the strength came into play, right? It was the wages. We actually did see employment uptick, it looks like, as you mentioned, 4.2 from 4.0%. Higher rates, obviously not what they want to see in terms of the pinch that it puts homeowners, right? We talked about the impact that has on mortgage owners and the impact that has on loans, obviously. Talk to us here, Michael, in terms of what are we seeing as far as the British pound in reaction to, right? Because we tie that into the U.S. dollar. I initially looked, it was lower. Now it seems higher. But this feeds into, when you see the currency in reaction to expectations for higher rates, I mean, really coming off, it feeds into concerns about the economy. And as you mentioned, it puts the Bank of England kind of in between a rock and a hard place here. And we're seeing a reflection of that as the currency's been coming off.
Absolutely right. Yeah, we got 10-year gilt rates here at 4.62%. Those are the highest since 2008, and that's really going to affect their mortgage situation there as well, too, as they have a lot of floating rate, adjustable rate mortgages in the UK, unlike here in the US where we mostly are fixed rate mortgages as well, too. So that's really going to put a lot of pain on the consumer there that are going to be faced with a higher home costs as well, too. And like you said, for the British pound here as well, too, it's really kind of a mixed situation here. We're slightly in the green today, hovering just below above the lows we've seen since June. They're at that 126 level. That's a very key level here for the British pound futures there, because if we take out that level there as well, there's not much support until we get near that 124 level. So we got about a 200-point downside move where we take out strong support there as well, too. And I think the pound is kind of in a mixed picture. There's one, we got higher potential interest rates there, and that's usually favorable for currency. However, we're seeing kind of a little bit of a risk-off mood in general here in the global economy there as well, too. Starting to see equity markets start to pull back there. We're seeing some emerging market currency fluctuations. We're seeing, the Argentine peso down, 18% there. We're seeing Russia raised rates by 3% to support the ruble, which went over 100 to the dollar there as well, too. And we know the situation in China, there were really weak economic data there. And now the People's Bank of China, they're lowering interest rates once again. And when they stop, doing some of their numbers there for youth unemployment there, the numbers there are pretty dire as well, too. So we got that flight to safety there, which usually favors the U.S. dollar against, like I said, higher interest rates there in the UK there, which is why we're seeing, I think, the pound here just kind of choppy here and range bound here right around that 127 level here. So I think tomorrow's data there, we got CPI figures coming out for the UK as well, too, expected to be below that 7% handle, 6.8 perspective there. If that starts to run a little bit hot as well, too, we're going to see that probability of a 50 basis point hike increase there, and that may add a little bit of support here to the British pound.
Sounds like the takeaway here is that it just kind of adds to some of the uncertainty right now, and is going to keep us as traders, as investors, on our toes and closely watching the data and markets reaction too. Appreciate you joining us here for a look at some of the numbers overnight, talking UK employment figures, the stronger than expected wages component. Michael Zaremski, Director of Futures at Charles Schwab. Let's bring in the chart master, Rick Takats, joining us here this morning. He's got his eye on one of those straws that's been building and mounting on the camel's back. Rick, we've been talking about yields to the upside. We've been talking about crude. We were just talking about UK and the Bank of England, how they're responding to higher wages. What are you seeing in terms of yields here in the U.S.? Because it does seem like as they continue to inch higher, we're starting to take notice a bit more.
Yeah, well, we spiked up a little bit with our chart, and we can recently, but overall, the broader picture is still within some of the boundaries that we've established during the past week or so. We're in a rising wedge type shape here on our chart, and we can also see that we're up about 13% or so since our 30-day lows. So this is a product that's definitely been on the move, Ben. And we can see as well that there are a couple levels that you may want to watch for potential support if the move up starts to falter here. We've got our old highs, our dark green line near 4.175, and our light green line is where price topped out several times and then saw some consolidation around that same area near 4.075.
Okay, so on the move higher, you can see attempting to work our way higher, but to your point, you're on the bigger picture, still relatively contained, right? As we look at your point, you're on the bigger picture, still relatively contained, right? As we look at the fall of last year, we were up around 4.3%, and I kind of feel like, yeah, we're going to be a little bit hesitant, a little bit nervous. Uncertainty will be one of the words we're using to describe investor sentiment and their approach toward market conditions right now as we near that upper level. But that would really accelerate those concerns, that uncertainty, and some of those fears. Should we take that out? Should we break out above 4.3? Let's look at the daily chart here and how we are still relatively contained. But Rick, I'm curious where this run-up puts us here and what it really signals to you as far as what to watch in terms of the bigger picture, longer-term chart and levels that we have identified there.
Well, really, we've been trending upwards since we saw that rally starting in early May. We've been traveling in an upward channel type shape here. More recently, we've seen a steeper trend line. You can see that purple line there that is a little bit more of an intense slope. It looks like this morning, just recently, we did cross above our old best closing high near 4.243. We aren't quite making our way above it yet. We just kind of peaked above it for a short time here, but that's a point to beat to the upside. One other thing I wanted to call attention to is that looking at the RSI, our measure of momentum there on the bottom, we're seeing a little bit of bearish divergence. Price is making new closing relative highs. RSI is actually trending downward. Is that a warning sign? Yeah, it is potentially. Does it mean for sure that things are going to fall off? No, of course not. But it's definitely something to watch, especially because we haven't quite crossed above those old highs yet. Slowing momentum as you're approaching resistance is definitely something to keep in mind.
Those that are calling for higher levels would probably push back on that and say this is one of the things we've seen as yields have been moving higher. RSI hasn't necessarily been participating to the same extent, but as I look at this, higher highs continue to play out, right? We took out the March highs. We're now on the process of taking out the June, July highs. Ultimately, it does seem we're kind of knocking on that door in terms of September, October last year. Rick, what do you look for in terms of the ripple effect here? Lastly, real quick, when we're talking about these and this being one of the headwinds for indices.
Well, I would say the first thing to watch out for would be our old closing high at 4.243. Then our intraday high just beyond that at 4.326. Either of those levels would be noteworthy if we crossed above them. To the downside, 4.156 represents our old highs.
Okay, so we'll call it 4.1 to 4.3, the upper and the lower extreme of the range Rick has his eye on. Definitely keeping an eye on the October, the fall highs from last year. Should we continue this momentum to the upside? And again, ultimately, the headwind that provides for stocks as we started to see them come off the highs for the year. Thanks to Rick DeCat. Thanks for you for joining us this morning to talk futures. That's it. Stick around, though. There's lots to come here on the TD Ameritrade Network. Headed your way next, Morning Trade Live, Oliver Rennick.
Good morning, August 15th. We're going to be streaming the stock market today, live trading stocks, options, futures, and watching some technical analysis, watching the SPY, GNS, GME, BBBYQ, RAD. Let's see what else is going on. We got WeWork, Tupperware. What's WeWork doing actually? Looks pretty flat. Did quite the move. Thank you guys for joining. Sub up, like up, comment down. Happy money sticks around. If you haven't followed us on Twitter, do it. It's at HappyMoneyYT. If you haven't gone to our Discord, do that as well. I'm going to put a link for Discord in chat and pin it. You can also find both in the description. Conveniently located. Down. Roll down. Discordian. We had retail sales, I think, this morning. It was not a whole lot of reaction. Pretty big sell-off, though, in the market anyways. Still holding yesterday's highs. Or, sorry, holding above yesterday's lows, so could be just a move to the upside out of the gate. Let's see. It looked like yesterday, after it built that bull flag and then it broke out of it. It was looking like it wants to finish this cup right here potentially, and then we'd maybe get a little handle to then maybe finish this much larger cup. Kind of a double top on the market. That said, I did open up some longer term SPY puts as a hedge, so might average into some of them if we do get a double top, but guarantees, because we are still in this downtrend. So we have a breakout, it's a downtrend. Yeah, down almost 0.7. Just going through and looking at stocks. Stuff my long term, stuff I'm kind of selling out of, and kind of selling out of stuff in the long term to commit it more to theta farming, which would kind of work its way back into long term as stuff gets cheap, and I'm wanting to hold it. Yeah. But, Horizon is on there. I haven't looked at Square in a while. Yeah, pretty low IV on the Square options. Could be a nice one though. Root. I should dump root. Somewhere this last night. For some reason it's separate positions on my account. I don't know why. LQR, volatile, still breaking lows though. Let's see, yesterday the low was the same low as the day before, so maybe it's flattening out now. That would be neat. Go down this Yaz a little bit.
Has an important role to play in the inflation
little pre-market,
of course.
Pre-market.
It's been under pressure for so long, but generally has been firming these last 20 days. That on the margin, crude could tell us whether or not inflation becomes problematic inflation. An important distinction, I think. Problematic inflation being defined as something that requires the Fed to do more than what's currently priced in. A few charts real quick before we talk about some of the retail stuff this morning. Number one is VIX, set to open around 16 right now. VIX futures, about 16, so a little bit of a pop. But yesterday, with the rally into the close and throughout the second half of the session, volatility slipped a little bit. And then despite some of the weakness throughout last week, VIX continued to just kind of retreat off those recent highs. Do want to call to your attention, though, in the middle, kind of left third of that chart, those two big green bars where VIX bounces off the low. That's July 27th. That's the high of the S&P 500. That's when the story here started to refocus on inflation. It was a day we had a bunch of good economic data, including GDP. Stocks peaked out early in the morning, pre-market. That's the S&P 500's high, that bounce in VIX on July 27th. And last week, as the VIX was slipping, it came right back down to that roughly 15 level. So the VIX popped to 15 late last month on better than expected data. And now we're finding a little VIX support, it seems like, at 15. Now, technical analysis on the VIX, some describe as a cardinal sin, but hey, we're bouncing right off the level where we were when the market seemed to wake up to the still imminent risk of problematic inflation. So something to think about. Watching the dollar too. A little bit of softness in the dollar this morning. We're watching some of the other central banks around the world, including the Bank of Japan, to see if they're going to have to turn more hawkish. But the dollar's connection to the yields is becoming obvious again, and that's very important. When the yield moves higher and the dollar moves with it, that's a market telling us that there is growth in the economy, which there is. GDP expectations have been ramped up, and as yields move higher, the dollar moves higher with it. We need to be aware of any potential hawkish language coming from the Fed speakers. Dollar chart looks real stable right now and pretty solid. I got Kevin Hanks and Renita Young with me here in studio to talk about the consumer and retail. So Home Depot's down a little bit, but bonds are also on the move, I think maybe a little bit more. So let's start with retail sales, Kev, because it seems like we got a little bit of conflicting message on some of the stock-specific front where Home Depot's earnings were imperfect, but retail sales beat and bonds got smacked there for a moment.
Right. Well, bonds were heavy to start anyway.
Yeah.
But yeah, this number certainly didn't help. Retail sales, the month-over-month headline number, up 0.2 a month ago, looking for up 0.4, comes in up 0.7, so almost a round tripper on based on the expectations. X vehicles, stronger, you would think, up 1% versus 0.4 expectations. X vehicles and gas stays up 1%, so a strong number out of retail sales, Oliver. And you're right, that added to the weakness of bonds. Stocks seem to be pretty much at the same levels in terms of futures where they were. They gyrated a bit, but all things considered, a strong retail sales number. U.S. consumer maybe not showing up so much in big ticket items like at Home Depot that Renita will talk about, but certainly across the board, X vehicles and gas both up 1%, strong.
The year-over-year number being particularly big, I think also kind of brings to mind this calendar effect of the data that we're going to be dealing with in the second half. A lot of folks have talked about the comparables from a year ago when we were kind of in the middle of that first COVID thrust. You know, we had a lot of easy comps for inflation and data, but particularly inflation coming off the peak. But now as we move into the second half of the year, when we start to see some of these numbers like retail sales posting some pretty good year-over-year figures again, kind of makes you wonder where inflation comes in the next, not quite second half, but next 4 months here.
Yeah, how hard is it to get from the levels we are now, which seems to be, based on interest rate increases, relatively smooth, flowing down, a little stubborn, around 4.6% in the year-over-year core PCE. But now I think the job gets much more difficult, Oliver. This getting to 2% may be harder. Why? Well, think about some of the spending. Think about some of the things that haven't even hit. We talk about lag effects with higher interest rates. What about lag effects in spending? Yeah. The CHIPS bill hasn't even been appropriated yet, hasn't even started spending. So there's higher interest rates, restrictive interest rates in the pipeline, but there's also a bunch of government spending in the pipeline.
Sure.
I thought the Fitch note this morning was alarming. They're not saying anything new, but it's still alarming that they're looking at this, because if they start lowering, and this is an if, I start every conversation that we're going to have today about Fitch and lowering the rating with a big IF, because it's if they do it. They haven't done it yet, but if they do it, well, some of the things they're talking about pretty ominous.
Yeah. Where do you think, just real quick, I mean, because this is a pretty big discussion, but after Moody's downgraded the banks, Fitch now doing the same.
Fitch warned in June,
yeah.
right?
And then, of course, the overall sovereign debt downgrade too. Is this like a statement they want to make almost? I mean, it's interesting that this would happen now.
Right.
5 months removed.
In kind of a quiet period for economic data,
yeah.
Quiet in between kind of a chasm of economic data.
By the way, which showed quite a bit of resilience in a lot of these banks.
But they did mention by name the federal debt levels. And the fact that they're not decreasing, they're increasing. And so I think, listen.
So Fitch is not a believer of modern monetary theory, basically.
Exactly. That fair amount of debt is acceptable, yes.
Okay, let's talk some Home Depot here. Probably our most important earnings coming into this basically at 52-week highs. Not quite, but close, Renita. And housing sector that's been so important to our recovery, but yet these sales are not going in the right direction.
I think we could see some cracks in this whole story, right? Because sales did see a better than expected number, and earnings came better than expected, but it was the fact that sales fell from last year and the fact that same-store sales are now in their third consecutive quarter of declines, and the company is expecting same-store sales to decline for the full year. So adjusted earnings came in at
Good morning, guys. Good evening. You're well rested. We got about 20 minutes to market open. Got one like on the board. Thank you for that lost soul out there for thumbs up the stream. And good morning, Kitty Daddy. Yeah, I like to start the stream about 8:30 or 9. I get it going and kind of go through some stuff, and then start chatting with you guys about 9 if I can. Yeah, that huge wick on SPY. We're on the moon. Good morning, Robert. Good morning, Bubblicious. Got more AMC. Got more of it. Wow. Are you expecting it to rally into the reverse split? Typically, stocks dump when they reverse split. Before then, I don't know. I suppose you could have a rally. Hope RAD doesn't let us down. Actually, still bullish on the daily. Still a chance. The AMC is up 2.25 pre-market. Runs down 1%. Upwards down 2%. Charge point down 0.77. Smoking a wedding pie king cone. Good Nas. Good morning to you too, Bubba. Nothing like a little morning Nas.
We still do have some earnings coming in, but all of this in the context of Jerome Powell.
Pow. Pow. .711 update on Weeble, or is that a Windows update? My left eye is like sore. It's part of this sickness. That sucks. It's swollen and kind of hurts. And now it's moved more nasally, so you may hear. Still never like a sore throat, which is really nice. And hasn't really affected my energy for the most part. Weeble. Yeah, there might be a lot more to it. I've just noticed a few things so far. On GNS, hold. Hold. Old. Eyes rallying up there a bit. Open. Flaxseed oil. I know I had some. It was awful. And then I didn't have it again. Fills up as halted pre-market. Uh-oh, bankruptcy warning. There's options including bankruptcy protection. How do we get bounced around SPY? Lookout window for 5 minutes every 2 hours? The heck? Look out the window every 2 hours? It is beautiful out there. Nvidia, I think that's what was taking care of it yesterday, wasn't it? Morning, Turtle. Guts. Markets being manipulated? Potential, yeah. Most of the market's manipulated. I wouldn't be surprised if they were messing with the bonds. GNS is down 10.5 pre-market. We'll see if we get consolidation at some levels or profit reversal. We still have a date for X divvy. So potentially you keep rallying until then. But I might be taking profits on GNS today. We'll see. Aloha, Maui. Yeah, I did, Turtle. I messaged you back. Oh, for your vision. Yeah. Yeah, focus on different lengths. Different focal lengths. Blink. Yeah, no, my eye. That's good for your eyes, yeah. My sore eyes from this sickness. It's not like... Yeah. No, I get up, I move around, I stretch, I walk around. Often. Often. Sitting is awful for you. Yeah, man, I'm telling you, this is COVID cough. It's going around. Standing desk. I know I could get a standing desk. I've thought about it. I don't mind just standing up, though. I mean, I don't want to just stand up all day. Oh, it's fine to just stand up periodically and walk around. One point I would do push-ups, hop down, do push-ups. Probably a good way to have some patience when you're in a trade. Pop down, do 10, do 20 or something, and then just give time for the position to work. Yeah, they're not used them before, but I would have to like fix all my cabling and stuff, which is a hassle. Routing all my cables. All right, we've got about 5 minutes to open. I'm playing Vader TV on a different platform, so what's nice is it won't click out.
Every time we get into the 80s, is there a point or a move
I can click
that
here and it
tells
stays
you
on
this
top.
is a little bit of a return to 2022's regime, a problematic inflation regime?
Yeah, I think once we get over 85, closer to $90, and it stays there for a while, that's going to be a real problem, and that's going to kind of destroy my scenario of a Goldilocks scenario. But you have to then look and see, the supply and demand out there. You do see China being very, very weak, which means that their demand for energy might be a little bit lower, which might, kind of put less pressure on the world market. But anybody who tries to guess and know exactly where oil prices are going, should take up another game, because it's a very difficult thing to do.
True. Okay, so how do you hedge then? How do you hedge your thesis, Ed? Is it just selling bonds? Is it selling calls in the stocks that you like, or what's the way to potentially brace for any surprise to that Goldilocks macro situation?
Yeah, and I don't believe we're going to have a big sell-off. So selling covered calls on my equities is a great way to go, because I don't expect them to soar anytime quickly, but I don't believe they're going to go down a lot from here. So, you got to find those high premium stocks. Those are the only ones that make sense to have covered calls. And remember, when you're doing covered calls, your goal is to get the stock called away from you. That's when you get your best annualized return. So I do believe that you got to find high premium stocks to write covered calls on. For those stocks like Home Depot, Lowe's, there's not going to be a lot of premium on those, but it doesn't hurt to write covered calls on those to reduce your cost basis. I'm not a big believer in shorting bonds at this point.
All right, got about 3 minutes to open.
I believe that we're going to have a negative bond scenario.
Got 10 likes on the stream, guys. I appreciate it.
What about later this month with
Jackson
Hole? Powell got pretty hawkish there in the past, but this time he's not even on the schedule yet. We don't know the schedule. So what do you think we should kind of have as our baseline for his commentary if he does? I mean, I would think he's going to, right? We're still more than 1% above his target. He's going to show up to this thing, right?
Well, of course he is. He has to. I mean, the whole thing is for the Fed chairman to speak.
Whoa. Here goes the sound guy again, jacking everything up. We've had negative macro news for a long time. Spies forward, it's front running it. So this was the sell off from the macro news. But once the news actually turns around, that's when we start to sell off, essentially. Because this has been all very bad news also. Like interest rates and stuff. Once he starts pausing and that sort of thing, that's always when the markets come down the fastest and the most, after we've been in a rising rate environment. Because the market's always ahead. This rally right here, it's ahead. I'm not sure on GNS. Probably just consolidate some. Have some pullback. It's down 12. Pre-market. Guess I'd like to see it hold. I don't know where this line's from. Alright, market's open. GNS is down 12.5, dancing around. SPY opened up down 0.35%. Yields up is halted. SYTA, this was Zip's pick. A-Safe's ripping. Good earnings? Yeah, good earnings. Need a little softer, yeah. It's SMMP is up, Vulcan's up, Wayfair's up, Lyft is up, RAD's down 1.3, GME is down 1.1, Barbecue's down 2. Put a fat dip in and wait for perfect premiums. Alrighty then. Alright, GNS is down 8. Bounce out of open there. RAD is green 0.5%. AMC's up 1.5. Run is down 1.7. TUP is down 2. Liking how it's bouncing on this level though. See if that continues. At 32.50 on Tupperware. Just waiting for it to settle down. Bye. Got a lot of orders that are being filled first few minutes. Give us some direction. All sorts of ways you can play it though. I mean, some people open up strangles, you know, right at the open, and just sell them off as they make money for them. Liquor House up 6.4. GNS only down 7 now. Oh, you puts from overnight. Yeah, I guess good to have a plan before you open it, what you're gonna do with it if this happens, and what you're gonna do with it if this happens. We do have a pretty good gap down 0.44%. We're retesting that resistance, and it from the pre-market, it rejected. So it could come down and retest the support. Since it's showing resistance here, I would probably wait a bit, but you're gonna lose that premium. Good to sell options in the morning. That morning premium. I want just a nice red candle to dump it. After it starts to settle down, the premiums start to come down. No, I didn't see your post. These neg calls are dead. Carvana's bouncing there. So you've got this double doji, which is kind of a reversal candle. You also have it on a resistance, so could read into that it's probably going to go down. You'd probably have it take profit somewhere down here near the lows. Kind of have to buy testing on its range a little bit. GME's down 2%. Barbecue's down 4%. RAD is up 1.4. Got some making up to do, RAD. Dish is still in that channel at 1.5. GNS down 11.5. RAD 1.7. My stream probably won't help you with your gambling itch. Happy Tuesday to you too, Zia. I got some puts. I got in, I got back out. I'm gonna wait. Wait a little bit. I think we could test the lows though. I don't like trading the first like 30 minutes to an hour. You just have to be so much faster with your entries and exits. Much easier after it slows down. The open trades and run them for an hour or two. You can ride them and you're in the right direction. Morning, you just don't know direction until at least a bit usually. Nice little bouncer on GNS. Docs down. Reversely? Reversely? Like which way? The downside or upside? It's reversing its downtrend to go up. Yeah, it's the morning. But yeah, looks nice. Looks like it's maybe consolidating. Be fine to see a couple daily candles up here in this range. Yeah, this is just way too tight of chop. Usually when I have puts or calls on SPY, just to hold overnight. If it went in my favor, I'll usually close them within the first 5 minutes. So in this case, if you had puts and we gap down, you know, 0.5%, I'd usually close them. At least some of them. Sure, sometimes it doesn't work out, or it works out, but sometimes it, you know, could have been better, but also can be worse. YTA's halted to the upside. That's where scaling out helps too. You can sell some at the open, and then you still want one exposure, so you're not trying to buy back in and do something foolish. You can leave a couple. To scratch that gambling itch of having exposure. Dock firmly below that support now. Dang, dude. I think at one point I was up pretty big on these calls. There was a time. I think Joan and Rad are in the same basket. They're both like mirroring each other. There's a red candle on Les Spy. See what happens if we get to low of the day. Yeah, GNS is almost green. Wow. Big pop up there. Very reversely. High coming down. We break. Excuse me. Break pre-market. We've got yesterday's low to mess with, 444.38, and then I guess that's Friday. Friday's low, 443.35. I'm being patient. I took earlier. I took a loss on, so waiting. Morning. It is mooning. Or did you mean to say NVIDIA good morning? GNS is only down 4.4 now, so solid bounce off of that open. Buy still coming down. AMC's down 1.5. RAD's down 0.7. Fun's down 2.5. Up's down 5. That 32 holds again. Barbecue down 2.6. 230. Price coming down more now. Nice, well done, Turtle. Now just chill. A lot of people can make money in the market. A lot fewer people can not give it back. Up is still halted. SYTA is still halted. Got the coffee, brew it. Morning, Tasty. Yeah. Look at that GNS bounce. That's not bad. Holding up so far. GNS only down 1.9. GME down 2.5. So yesterday's candle in GME looked pretty bullish, and looking at it, there is some support there at 19 bucks. So, and yesterday it's possible that was the low. Wait and see. I think could still break through there and hit back in the 18s. Gotta just sit on your hands, turtle. Chill. You got the gains. I mean, you gotta do you though. Gotta play how you play it. Giving gains back though. Getting back into trades too soon. This isn't really a channel at all for signals though. I give my Theta Farm members signals, but that's a non-gambling account portfolio where the timing doesn't really matter a whole lot. It'd be the same day. Yeah, I mean, GNS is holding up well. I'll gladly welcome a consolidation day. Maybe even to pick up some more. Premium content, you gotta pay premium prices. No, don't do that, turtle. This is an entertainment channel. Hopefully you guys are entertained watching me lose money. SYTA is resumed. Wheels up will probably stay halted for a bit. Talking about bankruptcy. See, this is something that could have happened to barbecue. I think it could happen. I mean, now they're in Chapter 11, but I don't know. I don't know how they decide. Oh, how that's decided. these sounds. A text sound? Weird. Another chop day? I mean, yesterday wasn't really a chop. It just, we had a, a lot of buying in the morning, and then it consolidated all day for the most part. Made a bull flag. Felt like chop because we just consolidated most of the day. But a chop day is even worse than this. And then we broke out of the bull flag in a day. Not sure. We're still kind of in the middle of a... We're still kind of in the middle of this range, so got close to testing the highs. I guess we kind of did in the extended hours, but so theoretically that could be the high. Now we're going to come test the lows again, but kind of in the middle of the range. So just I don't try and make predictions. I guess just try and look out for what charts look like and go based on that. As far as having bias, oh, it's going to do this or this or this. I'm going to get that out of my head so I don't bring my bias to the market. Dang, GNS. Thing went green for a bit. GNS is green 3%, dude. Wow. GNS is ripping 5% up there now. I did get into some spy puts there. We're at the low, so I'm gonna have a pretty tight stop. There's a little flush. Closing a couple. I just made a double bottom. Get a breakthrough here. There we go. Excuse me. I'm gonna stop for break even on the rest. GNS looking alive. GME's down 2.8. RV's down 3.5. RAD's down 1.7. Come on, RAD. Do me like that, man. GNS, man, that's great. Evidently breakfast sandwich. Yeah, I guess make predictions, but not have a bias to see a pattern either way. And just trade based on that, I guess. To let it set itself up. Like here we have an inverse cup, could be forming, but it doesn't have to. It could turn around here. Now that the momentum's broken down, just have a little bit more support to go through. If we do, then I think we probably could retest the 444. But we could also get a bounce off pre-market and start rallying up. And continue to the top of this channel and making potentially a bigger cup here, since we did have that that bull flag's pretty much done now. Yeah, looks more like an inverse cup at this point. Breakfast sandwiches are so good. Lift going? Yeah, lift. Is that on earnings? What's going on? No, just exuberance from earnings. That is neat. GNS is green, wow. $7 trillion market cap. Alright, there's retesting the low of the day. I'm gonna close a couple more. There's a flush. Alright, good. I made that decision easy. Good looking flush there, wow. Four 410. Where is that from? I don't even know. GME down 3.4. One more here. GNS up 2.5. Wow. And slowly scaling out of these puts. Probably look for a reload if we get another good entry. This was a nice little bear flag that set up for us. And it hadn't quite tested the low of the day, so risk reward was small because it could have just bounced on the low of the day, but it ended up becoming big because we flushed through it. GNS up 5%. Oh my gosh. Awesome. Still flushing down there. Just barely consolidating, just a little bit. That's pretty aggressive selling. Down almost 1%. Wow. Nice, Bubba. I'm not going to be calling the reversal yet. Right, if you're just looking for a call to just close real quick on a little bounce, you're probably going to get a bounce and consolidation, and then you're going to find out if it's going to keep coming lower or if it's a bounce consolidation and then a reversal. But that could take hours for a longer term trend. Depends on your plan. Try to get in and out within a few seconds. Then yeah, you can take a call and get a little bounce and close it. Nope, you got to close it right there. Hope we get some sort of continuation signals. Actually, I'm going to leave these open. Leave my stops on them. Really, we have until 442. We're going to retest the bottom of this channel. Not saying we will, but might not get a reversal today, or we break the high of the day at least. I'm gonna move this stop on that thing way down. Buy the dip. Oh, on GME. I'm not gonna buy GME. I might get calls in it if we break some resistance here. I want to see both these trends break. Till then, we're in a big inverse cup here. So I think 18 is probably next stop. Jeez, the IV premiums are jacked on the puts now. What'd you do? Got some Target puts. Weeklies. Yeah, looks like it's about to fall. Fall flat. GNS is green, 3.5. That is neat. Get one more new low on SPY. See what we get at that support. Got some 443s, but premiums are jacked right now. Out of those. Am I making money if I put this one up? What ticker? Stock. What option? consolidating down here. Maybe make another bear flag. Kitty daddy bum. Buy? Are there dailies at the money? I mean, the stock's not going up, it's staying flat. But yeah, the premiums on the puts are jacked because this drop we just had. So they're retaining their premium value since we haven't reversed yet. It's just like holding out down here. We start to show some reversal, we'll decay real quick, especially if they're dailies. What's BG3? Kitty daddy. Baldur's Gate. Like an RPG? Never heard of it. I'm out of the rest of those. I might reload. We'll see. I'm gonna be patient now. Went from red to green today, so overtrading is what kills accounts fast. Yeah, I mean, sometimes that happens. There's more demand for puts, then the price is going to go up. Usually you don't see it happening on SPY. Unless there's a catalyst coming up where Ivy just increasing. Can't believe GNS green. GME's down 3. Five down 1.75. RAD down 2.5. How can it be RAD? Yeah, the premium on the option chain right now is pretty high on the SPY. That volatility just jacked it up big time. Big time. New low of the day there on SPY. Looking for 443.35. See if that holds. Nice kitty. Still halted. We got TTOO boosting up today. Ripping 27%. Look at that. Oh, it never let up. TTOO. Kind of just held, huh? Held that trend solidly. Made its cup. Made its handle. With some dramatic price action between. Now you're getting the breakout. 54 cents. Here we go. Oh, run down 5.25. Blech. Why run? AMC is up 1.7. Almost 2%. A little poppy there. Up is down 6. I'm putting a stop on these puts. Premiums are high. We're at a pretty low. I'll just close them. Yeah. Okay, need to chill. Let it go down. Maybe I'll catch a reversal today. GME is down 4. ETOO ripping 30%. GNS back to VWAP. $4.25 on GME. Oh yeah, we're getting there. Getting to yesterday's low now. Probably get a little bounce here. Maybe back to VWAP, somewhere around 19 bucks, I'd say. Maybe they got that approval. I'm not sure. See. Don't see any news on an approval. See if SPY continues this trend. It's still in a bear flag here. Liquor is up 4. ABNT is up 3. Breaking out of that bull flag. You know, 9. 1 penny from the low of yesterday on GME. New low of the day there. There's your flush. As I was waiting for those puts, premiums are high and the risk to reward down here is not that great. 443.35. Hit it. 443.50. Very well could go below there. Doesn't have to stop there. There's a gap down here, it looks like, at 442.75.
boost the outlook, but you can see shares getting punished, likely because of that earnings miss and just how high the expectations were. Running through those numbers, EPS of 4 cents per share, as you can see, missed analyst expectations of 13 cents per share. This is a Swiss company, so it reports in Swiss francs, but translated to U.S. dollars, reported 494.0.
Dude, premiums are so elevated right now. This is crazy. Oh, am I trading tomorrow's? Oh, that's why. Have I been trading tomorrow's? What? I've been trading tomorrow's. Why? I don't see today's strikes. That's why the premiums have been insane. Look at that perfect bounce on GME off of yesterday's low. That doesn't make any sense. On TD, are you guys able to have today's strike? It's only showing me tomorrow's. Really weird. There. That's so weird. I should refresh. That makes sense. I was wondering why the premiums were high and they weren't moving a whole lot. Too low.
You can still see some note of caution because it's highly contingent upon consumers. And even though it's benefiting from the trade down effect, we can still see that consumers are being more cautious about how they're spending. So,
yeah, I sold barbecue
adjusted
yesterday.
earnings are expected to be flat from last quarter at 76 cents, but higher year over year. And revenue is expected to come in at 12.
Yeah, that was weird. I just had to refresh. It wasn't
now,
loading
this
them.
stock has outperformed the broader market over the past 12 months, and that's partially due to the trade down effect that people have been participating in. And at least one analyst has hopes for the stock, which is up more than 30%.
Dang, it would have been up a lot more this morning for those were dailies.
They have hope
I was trading them right.
to rise a little bit more. Barclays is raising the price target to $100.
80, 100%.
It's around a 17%
20 or 30%
upside from where it's been trading today. But two potential headwinds exist for this company. It's the possibility of higher freight costs in the coming months, and it's that restart in student loan payments that may suck up the discretionary spending of people.
Yeah, it's not going to be good if TJ sales start to slow, because that means we're really pinching our pocketbooks. Okay, so the stock up 30%. Even as sequential earnings are going to be flat. Could be one where there's a little bit of drama, but generally TJ doesn't have monster swings on earnings. It's just not a very volatile stock, it seems like, Rick.
It hasn't been very volatile lately either here. We had a nice rally upward. It took us up about 16% since the end of May into our yearly highs. But things have been much more sideways lately during recent weeks here. We also broke through our upward sloping trend line. We've just been kind of drifting to the side now from that point here. Our 21-day EMA has been supportive, but we haven't crossed below it for a couple of months now, I want to say. And we can see that we are on the verge of crossing below it today. The moving average itself has flattened noticeably. We're much more sideways than sloping upward now. We're also slipping below a volume node that's centered around the 86 level. That's our blue bar graph on the right side of the screen. You can see there's a bit of a spike in it around that level. That suggests that there's been some price acceptance at these elevated levels. So I guess the thing to look out for now would be some consolidation and then a breakout to the upside if you're feeling bullish about this name. Beyond those old highs near 87.42, 87.50 or so, around that level would be where the bulls would want to see a big move beyond that point. Now, Earnings could change everything. We can see that, as I said, our moving averages are kind of slowing down here. Momentum, according to the RSI, is waning. We're right near that 50 midline right now that separates bullish momentum from bearish momentum. None of this is particularly uncommon heading into earnings. We've got an event risk coming up, so it's not really unheard of for something like this to be happening.
Sure.
But still, what we'd want to see would be some kind of breakout beyond either those old highs or perhaps beyond where we topped out before around the 85 level.
It is slowing, though.
It is.
No question about it, right? I mean, you're seeing notes from analysts pumping up NVIDIA and stuff going into their earnings, and certainly not out of the question to have some additional strength and confidence going into the report. TJ kind of fading here, I feel like, does put the pressure on the margin for them to deliver something good, especially when there's so much trading that happened at that big volume node. Seems like there's almost a little gravity, a little magnetism perhaps down there. All right, good context, definitely. And that big node is at what, like $78?
The big node that we saw, the volume profile point of control, is around $78.
Okay, all right. That would be a big slide if we have to go back there. How about Brinker? Not the worst chart, not the best chart, kind of just sideways, but pretty choppy.
Pretty choppy, and there's a reason why, because although inflation and higher ad expenses, other investments have eaten away or expected to have eaten away in margins, the company is still expected to post top-line growth year over year, and that's where analysts are a little bit more positive on the name. But it's still highly impacted by the consumer, who is pulling back. Now, that solid performance, though, of Chili's is what is expected to carry these earnings as the company raised menu prices and consumers paid for it. The company also did more marketing initiatives and development efforts to aid in this boost, and it led to improvements in foot traffic. So analysts expect adjusted earnings of $1.30 a share on revenue of just over $1 billion.
Okay. $1 billion. That's a lot of, well, let's see. What's our favorite Brinker? Well, I guess we shouldn't play favorites, but that's a lot of Chili's. No, I'm going to say favorite. My favorite's Chili's.
Chili's, Maggiano's, you know.
Yeah, Maggiano's too. Really good delivery value in Chicago, by the way. Okay, Rick, what do you see here?
Definitely a messy price action here, like you guys were saying here. And we can see that the first thing that really strikes me is that the price action has largely been in more of a triangular shape here. We did have a big downside excursion. Price rapidly went back up to go back within the boundaries of our pattern, though. And we formed a double bottom at that green dashed line near about 32.60 or so. That matches up rather well with the old lows that we saw there. So that's definitely a point to watch, especially because our expected move is around $4. That would take us roughly to that area there if we were to break to the downside. And things are looking a bit more negative this morning here for the bullish crowd here, looking a little bit more bearish price action here because we're breaking below our lower trend line. We're breaking below our purple 252-day EMA. We're still sliding. We had about an 8.5% slide as of yesterday's close from our highs near the $40 level. We crossed below all three of our moving averages. We crossed below our volume profile point of control. So really there's not much positive that I'm seeing in this chart in the short term here. Our moving averages themselves starting to slope downward as well. A sign of trend change overall here, or rather a warning sign of trend change. Once again, heading into earnings, though. So that could rewrite this whole story here. That could change a lot of things here. But we're breaking through the support levels that I had my eye on. One area to look to the downside would be around 32.60, like I said. To the upside, we've got a confluence near about the 38 level. We've got our 21 and 63-day exponential moving averages coinciding with our volume profile point of control all around that level. So that could be one area to watch for resistance.
All right. Pretty interesting chart as it all comes together there. Really more than just a sideways situation, kind of more of a compression situation, which is always good for some potential volatility, I guess. Let's talk China, not to be left out, and a lot of compression of the economy there people are worried about. Tencent kind of near the lows, not quite at them, but real close to the year lows here.
And that's the trouble going into this earnings report. But we forget there was a whole quarter before what's been happening over the past few weeks to look at. So analysts are expecting earnings to rise year over year to 61 cents a share for adjusted earnings, and revenues expected to be just under $21 billion. Now, analysts are going to watch the gaming segment. That's the company's bread and butter. They'll also be looking at the advertising business. Last quarter, gross profit for the ad business grew about 33% year over year. So we'll see if the company can continue that trend. But traders are also watching Tencent's fintech and business services segment, and particularly the pace of growth that this segment will go at.
Okay. So if we do see something surprisingly positive here, it'd be a huge dose of much-needed confidence for the whole China trade. But I don't know, Rick, it kind of looks like this thing is, I don't want to say ready to break, but, I mean, it's on the precipice, is it not?
Signs are pointing more downward than upward, I would say here. You know, looking at these kind of broader picture scenarios that we kind of try to assess through technical analysis, we can see that we've closed below all three of our moving averages that we follow. The moving averages are starting to trend downward. We're below our volume profile point of control, these areas of heavy trading that can be support or resistance. That can be definitely something to watch out for. We're near the lower end of our pattern. You know, we're maybe middle to lower end of this kind of falling wedge type shape here. So really what you'd want to be beware of would be a break below the lower line of that pattern coming in maybe around 40.50 or so, and then that green dashed line there near 39.50. That's about where price topped out all the way back in what was it, November, then bottomed out, and then bottomed out again near May. So that's the kind of price level you want to look for a frequent stopping point, or where it kind of seems to find support or resistance.
That's right.
Old support
only at 17
resistance, and vice
from
versa.
Back when we were at 25.
To the upside, we've got a similar situation to our last chart. We've got a convergence of a lot of our moving averages coming near our volume profile point of control, kind of near 43.25 or so, around that area. But once again, moving averages moving sideways, clustering together, speaks to weak directionality. It would be slightly more biased to the downside, but overall not a ton of strong trend here to talk about.
Okay. So trying to hold on to lows of the year, basically. Kind of the goal would be for this to hang on to $40 at like worst case scenario without breaking down to a fresh new low. Good context and great charts. Nicely done, team. Renita Young and Rick Ducan. Coming up, we'll continue the conversation about earnings, especially those overseas. In fact, C Limited in Singapore down big. So it's not just China. The surrounding region under some pressure. Caroline Woods will take us through that ahead of our market meetup when we come back.
Thanks for hitting the like, Ace. Appreciate it, man. Palantir. Gonna hold till it hits 10 and buy more. Okay. Yeah. Might find support before there. Depends on how bad the market sell-off is. 14.21, maybe 11.5. 11.5 could be a good support. Morning. I can't believe GME bounce off the same level. I'm not thinking it's a double bottom. It's still in a downtrend until this resistance breaks. Build up some liquidity on this side of it. Excuse me. looked okay. I did get some calls down there. Not at the very bottom. I try and refrain from trying to time the bottom and the top. Sometimes I do. Small amount and then scale in, but for the most part I try and wait for the momentum. I got them in for the bottom of this candle. Give it much time. And my break-even stop out was triggered. Excuse me. GNS just kind of consolidating. Around VWAP though. ETOO up 26%. Got back into those calls though. Give myself a little more room for my stop. Yo, consolidating up here at 25%. There's your bounce on GME above VWAP. I add to my SPY calls here. A little inverse head and shoulders setting up right here. See if you break the neckline. You'll be able to make a move back to VWAP. Barbecue down 3.5. GNS pretty much flat. See if SPY can make a cup today. In the mood for a cup, SPY. Up the lantern at 7:15 May. Top ticked it. That's why the scale is good. The scale is great. The scale is wonderful. DGTX, yeah, that's been a runner before. Looks pretty good. Got a resistance to break here, but then yeah, you've got a nice gap you could fill. Other resistance there, 1350, 14 area. They failed the trial or something, presumably. Ah, RAD is green. This is the way. Oh. AMC's up 2. Barbecue's down 3.5. SPY's either setting up this bear flag still, or we've got a up potentially being formed. Little inverse head and shoulders here for the bottom. GNS is even, Steven. Alright, I'm adding to those calls. Do it. We may move back down to VWAP. Barbecue down 3.5. Groupon's up 7.5. Dang, that's a big breakout. ABNT up 6.25. We'll break out of that bull flag also. Here you go, SPY. Let's SPY. GGTX, I think. Turtle brought it up. Looked at it before. Haven't followed it too close. Alright, SPY's climbing. Breaking of that neckline. See if we get to VWAP. Or that pre-market low, we're hitting as resistance now. A little bit. Took one off, took a couple off. Feels better trading 0 days. Yeah. NVIDIA. It's kind of hilarious. GNS up 2. GME similar price to yesterday, but making lower highs. Same lows, which could be bullish. Just has to break out. There you go, SPY. Oi. Buy back to VWAP. Close out a couple more here. AMC. Yeah, AMC's up 3.5. Last chance for a squeeze. I mean, shorts can hold through reverse split. I have some exposure on AMC right now. I do. It's long. I plan to sell or close it before that 824 reverse split though. $6.25 on KBNT. Very interesting. 2.2 on GNS.
Of 85 to 90 bucks, it feels like that is indisputably a reversal of trend and would catch everybody's attention. So in a way, there's almost a positive in the China sluggishness is that some of our inflationary forces are still contained.
Is crude oil an economic barometer or not? So crude
yes,
oil
that is also a debate.
Does crude oil continue higher as the economy, this all brings back to renewed focus on what those FOMC minutes are going to say. Is the Fed all in that we're going to pause and we don't need to raise rates anytime soon? There's talk, there's dissension in the ranks, I think. I'm going to be interested to see what it says tomorrow. Rates have come up a lot, so.
Is it crazy? Is it as crazy to you as it is to me that I've heard a few times from folks that Powell may not even have something to say at Jackson Hole because they haven't released the agenda yet. I'm kind of obsessing over this because the fact that people are floating the notion that he might not have anything to say, to me, is like disgustingly absurd. How can he not say something when he's paused hiking rates when we're well above his target?
6 straight quarters of raising rates, pounding higher rates, right? And the long-term, the yield curve stayed inverted, or inverted even more. Now the curve's starting to steepen back. Still inverted, but the long-term rates are now saying the Fed might need to start raising rates again.
Ryan, what is the most compelling sign of that in your mind? You're saying the way the curve has started to widen back out?
The curve is steepening back out, so it's coming back in to where the 2s are not as far below the 10s, right? And I don't know, does it flip and go steepen back out? Do we see the 30-year bond up at 5%? It just crossed 4.3, so it's getting a little ahead of itself.
That's where it's important, too, because it's happening from the long end going up faster than the short end. It's not that the short end's coming down anymore, pricing as many cuts. Right. The cuts are starting to get priced out, and the idea is that we've got enough growth to kind of reinflate.
When you look at the CME FedWatch tool, we're a year out from now, we're basically, in the very shortest, point on the curve, we're basically where we are now. I mean, there's a quarter point, kind of what's being priced in, but it's basically flat. So all the movement, right? If you believe that tool and the narrative, and Goldman came out that note over the weekend, like probably until second quarter of next year for cuts. If you believe that the front end is just anchored where we are now, basically, that's not a terrible thing, right? For the financial sector, it's high. Don't get me wrong, but the insane fast movement that we had, 500, basis points over that 6-month period, crazy, right? If that stabilizes, which it already has, right? All the movement's going to be in the long end of the curve because it's not being pegged to this. So it's going to kind of pivot around that front end of the curve, and I think there's a lot more variability out there. You saw it in the home builders number this.
More lag on here. GNS holding 3%.
As well, it doesn't appear to be more than just that as of yet as we look at what's going on in terms of the areas of consolidation. This is the area of consolidation that we've been forming basically since the fall of last year. Upper extreme around 120, lower extreme here around 98, we'll call it. Really, as long as we hold up above 103, that longer-term bull trend, that narrative that value is forming at higher and higher levels remains a valid one. The bulls want to see us take out the highs that we saw earlier this spring. And again, crude oil, it's pulled back quite a bit here as well, right? 7 weeks in a row, I think it was, to the upside headed into this week. The bulls looking to make it 8 in a row. Just taking a quick look at where things are relative to the 50, the 200-day moving average, pulling back a bit. So again, a pretty good indication of that pause here, but holding at or above both of these. RSI has been pretty strong here as well in this move up. So again, I think Joe's on to the bullish narrative here. It appears to be the correct one still.
Right, understood. And these are great charts, and you see the crossing that's happening and the change that's happening, particularly over, as you said, the last couple of months where we've seen oil ticking off. Joe, what are you hearing about oil in particular, too? Do you watch that as well?
Yeah, no, of course. For me, it is a barometer of global growth, and it is, something that is very, critical very sensitive to the economy. So for me, it's just a place where people are going to park their money. People want to put their money when things get a little risky. Maybe a tones of a risk-off trade when people are just looking at, 5 years from now, people are still going to be using oil. 5 years from now, the energy is still going to be very valuable. I don't necessarily know about, property in the metaverse or, eyeballs on a screen, like things that are less tangible out there. I think that's the risky areas of the market. Things that are less risky are things you can put your hands on, oil is inflationary sensitive stock, which I think people are going to be piling into next year.
You know, we were talking about Johnson & Johnson, which is the next name on your radar here, and a lot of talk about them offering to change over some of your Johnson & Johnson shares to Kenvue shares, which trades here, right? The more consumer type of things that they spun off at a premium, right? I think you make $7 on it every 100. So it's very interesting that they're putting that out there. In the meantime, people who own Johnson & Johnson love Johnson & Johnson for the long term. Where do you stand on J&J?
Yeah, this is another name that's seen really increased volume lately. A nice couple months for it that are really strong period here. For me, this is a company that, in an area, in a sector of dividend-paying stocks which have underperformed in the S&P 500. If you look at the top 101 non-dividend-paying stocks in the S&P 500, it's up over 20% year to date. If you look at the dividend-paying stocks in the S&P 500, it's down 3%. So this is an area where I think some pullback, some reversion to the mean is in order. I like that catalyst for Johnson & Johnson. I think there's potential upside. So yeah, again, this is another name. I'm just looking at October. Going to play it with calls. Going to have that defined risk for me, and just want to get in and have some security, but want to play it to the upside because I do think a nice return for the next month and a half is very possible for Johnson & Johnson.
Yeah, understood. Oh, so that's bullish. That's some upside there. Ben, what do you think about the J&J chart?
Well, I'd have to agree with that. Recently up above a key area, a pivot zone, and this is a stock that's done pretty well. It's hanging in there fairly well. It has been a bit of an underperformer, as Joe pointed out, but let's just begin with the 30-minute candles here. Two clear areas of consolidation. Seeing migration of value to the upside, currently balancing around 171, upper extreme 176-ish, we'll call it, lower extreme around 165, and inching its way towards that upper extreme retest here. The bulls want to see us break out to the upside. Joe mentioned here we've seen a couple months of strong performance from J&J. Taking a look at the daily candles, you'll see that really in a series of lower or higher lows, I should say, off the March low. That was down around 150. Again, back up and through 170, the middle of the range that we've been in, going all the way back to the beginning of 2021 with an upper extreme around, looks like around, we'll call it 187, 185-ish down to 150. But again, seeing some momentum through the middle of this range with the higher lows here. I think this is all very supportive of that bullish tone that Joe was speaking to. And taking a look here at where we are relative to the 50, the 200-day moving average, the 50 is just really starting to see some enthusiasm. RSI is lagging a little bit. I think the bulls would rather see it participate a bit more.
Coming down here a little bit.
Where we are net change-wise is
Joe
pointed out again,
all my stuff closer to
down
BWAP.
1%, 1.25% on the year still, but
might look back in the
very
puts here.
bullish setup here structurally and technically as well.
Right, understood. Okay, so a bullish tone set there. So final thoughts on this one, Joe, and then we'll get to our last one, Simon Property Group.
Sure, yeah, just looking at the October 175 calls, $2.90 this morning. So yeah, I do like the risk reward. I do like the upside. I do like the potential. There's been a lot of volume, just the last point, increasing volume as the stock's getting higher. So I do think the potential for the upside is there.
All right, and last but not least, we take a look at Simon Property Group, even raising the quarterly dividend. I mean, that's a surprise for a name in commercial real estate, but I guess that's one of the reasons how they're going to try and keep people in their real estate portfolio instead of maybe somebody going to some other one. What are you thinking on Simon Property Group?
Yeah, I guess they got to keep pace with the higher risk-free rates out there with the higher government bonds. So for me, this is an area where I'd want to avoid. This is an area where with the higher interest rates, they're going to struggle. They're going to have to refinance at higher and higher levels. I'm concerned about real estate eventually turning south. That'll be another thing that hurts Simon Property Group. So yeah, I'm worried about the short term. I'm worried about a downside here with the higher rates. So I'm looking at the September 115 puts. Those are 230 this morning. So just looking downside protection. Going to buy that volatility while I can.
Right, understood. So you're bearish, but buying that volatility and playing it in that way. Different type of trade and thought here. Ben, take a look at the chart.
Yeah, I did, Nicole, and I can understand where Joe's bearishness comes from and why he's looking to prepare for some downside volatility here. Taking a look at migration value, in this instance, SPG is to the downside, right? Basically the exact opposite of the two other instances we were talking about. And you can see 124 recently balancing around 118. This is over the last 2 weeks. We spiked down to 114 in reaction to earnings and have come off that low, but really have yet to take out anything significant to the upside. That would be 124. As long as we remain below that, we're basically under pressure here on that shorter term time frame. Now, this is somewhat counter trend to what we've been seeing on the more intermediate. These are hourly candles. This goes back to the rally we've seen from 100 end of May all the way up to 125. You can see balancing around 121, but you can also see that sharp move lower in reaction to earnings and the consolidation area we just took a look at. You can see how it's kind of forming at a lower level. So the bulls are hoping this is just one large area consolidation. Eventually we regain composure, but you need to get up above 121, need to retest 125 before you can get really enthusiastic or excited. In this instance, it just feels a little heavy at this point, like we are rolling over. I want to show you where we are relative to the 50, the 200-day moving average, a key level to keep an eye on. Look at the test thereof we're seeing right now in terms of the blue line, the shorter dated, the orange line, the longer 200-day, but look at the RSI and the enthusiasm we're seeing to the downside associated with this move, taking out the lows that we saw back in end of June. So again, there is some strength here. There's some energy associated with this move lower. Be curious to see if we can see some follow through, but sounds like I'm 3 for 3 with Joe today.
Okay. Final thought. Yeah, Joe.
Yeah, it's going to be all about interest rates. I think the economy is strong enough to justify higher interest rates. I think if interest rates stay higher, particularly in the medium, 5 to 10 year range, it's going to hurt this name. And I think it'll have a headwind to the downside. So just want to play it just like the other two names to the upside. I'm playing with calls. I have a defined risk in this area. I'm playing with the put. I own the put. I know how much I can risk the downside, and it's a nice protection for me.
Yeah, understood. Thank you both for the big three today. Really appreciate it. Of course, our own Ben Lichtenstein on the charts. And Joe today, Rational Equity Armor Fund. Thank you both. Coming up next, we're going to spotlight the retail sector. Back to school season is here. The big retailers have been ready.
All right,
and
Splash
we
is
have
chopping
several
now.
reporting this week as well. Lots to talk
No,
about.
we gotta wait.
Break down all these things.
Gotta wait. Ooh. Back to VWAP. Big old green candle. Making a VWAP break here. Do you walk, Ronald? No. I think it has it in it. This is still a SPAC, right? They never de-SPAC? Yeah.
than expected. We have back to school and a lot of names that are reporting this week as well. We welcome in Katie Thomas, lead at Kearney Consumer Institute. Thank you so much for being here.
Yes.
So it's back to school season. I know a lot of parents are cheering. They like to see those commercials where everybody says it's the most wonderful time of the year.
Yes.
You know, are people spending on back to school?
They are, yes. Thanks for having me today, Nicole. Yeah, I mean, honestly, part of me can't help but wonder if it's being propped up by these really fancy dorm rooms I keep seeing on social media that look a lot different than a dorm room looked in my day. But beyond that, I think in general, we really saw it kick off, and you can see it in the numbers as well with Prime Day and the associated sales. So you see it in those non-store retail numbers. Consumers love the deals, and they love to shop on back to school. Similar to holiday, people like to spend during those seasons. It's not where you're going to see a big pullback. They'll try to make trade-offs in other areas of their life, so they can still spend on back to school. And the longer season and the price competitiveness helps. They're able to shop across retailers effectively.
How do you feel? I mean, obviously, when we're trying to do comparisons, and we don't have the numbers yet, anything compared to 2020 is going to be better. Where do you think we stand, like year over year? How are people feeling and how are they spending, you know, let's say compared to last year?
Yeah, well, the numbers are up even more compared to last year. So I think the total retail sales was 3.7 versus a year ago. I think in general, my key message has been in some ways, no news is good news.
Right.
So the consumer spending, we haven't seen this massive pullback or some of the very obvious consumer behaviors we've seen in recessions past, which show that consumers just increasingly savvy. They're making the trade-offs they need to across the wallet, and being really thoughtful about where they spend and how they spend their money.
And we had on some pros yesterday also on retail. It's just a big week. I mean, you know, well, at Home Depot and Target and many others. And so the feeling was that names like TJX and Walmart seemed to be well positioned. There was some concern about Target, but you know, when you think about the different types of retail stores, do you have a thought on which ones may be faring better than others, for example?
Absolutely. I think what we're still seeing is premium do well and value do well. So some of the names you mentioned there, TJX and Walmart certainly, where we're seeing struggles is sometimes that mushy middle. So where people feel like they can get good bang for their buck, they're going to those value retailers, strong price perception, strong value.
All my mucus is coming out.
And maybe even something else. At a good
Spy
deal.
broke you up there. See if we can make a full.
They want to spend. You know, we've seen luxury still do well. It's
full
that
cup.
mushy in between. Some of your more
Got a lot of upside if it wants to.
retailers, where if they're not well differentiated, they're really struggling to find a place in the consumer's wallet.
Right, understood. You know, and Barbie has brought on a whole new excitement for shopping. I mean, I was saying yesterday I went to Bloomingdale's, which is under the umbrella of Macy's, but they had a whole Barbie section, and just pink dresses from different designers were featured. So how do you think that's fitting into the picture?
Well, I think that Barbie was a great example of partnerships that really ran the gamut. So they partnered with brands big and small, mainstream brands, niche brands, and allowed a lot of people to engage. And to your point, I think the pink really helped because even if you weren't an official Barbie partner, it was very easy to just have some kind of Barbie featured section that really played well into what people were looking for and buying.
Yeah, and then you talked about CPG manufacturers. Tell me about that.
Yeah, that's one area I'm really watching. I mean, we've talked a lot about how consumers have continued to sort of absorb price increases at the grocery store, a little bit of pullback in volume in certain cases, but I think that's an area that will continue to see a little bit of constraint as people weigh private label, more affordable brand options, and I think we're going to have to see both manufacturers and retailers continue to really find that balance between the high end and the low end, and what that mix looks like, and what's the right combination for consumers.
So these consumer packaged goods that, you know, food, and some of it is more
they say it's up 22% on earnings.
Real staple, like maybe you really need rice, maybe you don't need cookies.
Exactly.
But even that, you talk about the different brands and looking for value. I mean, a place like, and this is not publicly traded, but Lidl, I don't know if you know it, but it has taken over in Long Island But when you first go in there, there's nothing that you recognize.
RP's down
What do you
3.3.
think about those kinds of prices and how they may affect big, American companies?
Yeah, I mean, I think they're meaningful. We've seen it, I think, more across the country with Aldi, continuing, that's sort of more of a private brand, some name brands in the store. But it really is the price competitiveness. What we've seen is that consumers can really suss out the quality. And that's what you see with a retailer like Lidl as well.
You say suss out the quality?
And then, I feel like it almost being from the same area, like IKEA, right?
Yes, exactly.
And then the other thing I was thinking too, with people and how they're spending, you mentioned, top areas like Lululemon and Nike. If still many of the guests come on and say, look, that's brand, that's like more of a higher tier, and that does well. But what do you think people are spending on when it goes to restaurants and what they might get squeezed for the holidays?
Yeah, so I think that's another prime area where you're seeing strength on the ends of the spectrum and a little bit of weakness in the middle. So we've seen recent earnings, RBI, Yum Brands. Some of their banners in the more fast food sector are still really doing well. It's affordable, good value prop there. I'm not sure people are necessarily trading down, but I think that they're just weighing their options. You also see people being thoughtful about the nicer meals out. Maybe they're getting a glass of wine, not ordering the whole bottle, but they still want to get out.
Yeah, it's funny because they were saying that Yum Brands had easier comps year over year than some of the other names like Texas Roadhouse, Brinker, Potbelly, and McDonald's, that they had tougher same-store sale comps than Yum Brands did because they really have that big presence in China. All right, I'm going to leave it there. I mean, I did have one last thought, and this is just off the cuff, but I mean, what's going on with the weight loss drugs? There's talk that these packaged goods and food might actually suffer because people are eating less. So the weight loss drugs may be good for the pharma industry, but they may be bad for consumer staples, packaged goods.
7.
What do you think of that theory?
I mean,
I know you don't have any numbers on it. I'm just talking it at
I think it's fair. I think
it
it's
makes
fair,
sense a little bit, right?
And they're saying, it really eliminates some of that like overeating and snacking, which does, really do well for a lot of major manufacturers. I think it could be a dent.
Yeah, like if the whole world's on Ozempic and Wegovy and all these Manjaro, I mean, how many cookies? They can't eat all those cookies. It's very interesting concept, and we actually had one of the, I can't remember which one it was, but maybe it was Morgan Stanley, but I'm not sure, actually said that food could suffer on the heels of this. So that might be a story that we'll cover in the future. Thank you so much. It's great to see you. Katie Thomas of Kearney Consumer Institute. Thank you. All right, coming up next, the disruptors. George Sill is standing by. He's going to be talking about AppLovin. The company hits 52-week highs.
AppLovin.
Has adjusted
Remember that
targets.
ticker? This is APP. AppLovin. Why can't you pick a normal name? Most common name on earth. Read a book. AppLovin down 2.5. Did GME break that low? No. Nope. Nope.
from a software standpoint in-house. AppLovin's actually outperformed both of those larger names. Now, when it comes to digital ad spending, we know that there was a lot of weakness in the back half of 2022 with companies like even Facebook or Meta Platforms and Google underperforming. But this year has been a reversal, especially with digital ad spending improving. But the stock itself has really outpaced a lot of its peers. Now, if you look at the report going back to August 9th, they actually posted 22 cents of adjusted profits. Now, that again beat the estimates by about 15 cents. So they were expecting 7 cents in terms of adjusted profits. But if you compare that to last year for the same quarter, the company lost 6 cents. So the company switched to profitability, moved to profitability quite aggressively for this quarter. The other thing is sales. They did beat the estimates, coming in around 750 million, but sales were actually down about 3.5% year over year. And I think if you look at the profile of the business, the profitability profile seems to be improving because their estimates now have risen for free cash flow at around 1.3 billion for full year 2023. The company is also buying back about $200 million in stock. And it is a company that is gaining traction from EBITDA growth. In other words, their earnings growth is starting to improve tremendously. And if you look at some of the elements behind the analyst calls, for instance, Truist increased their target from 35 to 45, but going back to the 10th of August, Oppenheimer also increased their target to 45. The company's guidance for earnings growth is about 28% for this year. But if you look at the forward multiple, it's only trading around 16 times forward earnings. So one would say the reason the analysts are actually quite bullish on the stock is the valuation. If you look at the PEG ratio or PE ratio to growth, it's trading around less than 0.5, and that's really compelling considering the stock is also trading around 13 times free cash flow. So the company's valuation seems compelling, but also the growth rates and of course the technology. As long as the placement of ads is still in high demand, people seem to be less reluctant to switch to competitors if they try their services and software. They seem to have more lock-in features and value-oriented technologies that are a little bit of a standout, and I can see why the stock is continuing to trend higher after earnings.
I see. So with that happening and this trending higher and hitting 52-week highs, what do you think for an example trade?
Yeah, so I think overall, Nicole, I know the markets are very volatile in the last couple of weeks, but overall we're still in I would consider a mild correction, so you have to keep that in mind. So with that said, we could see some additional softness, at least in the short term, for AppLovin. I mean, today it's down about 2%. So I think overall the trend is still intact, and it might manifest higher as we move later in the year. So what we can do is we can sell short-term options to help finance some longer-term options by putting on what's called a long call diagonal spread. So we can go out to September, which is 31 days to expiration, and sell the 4250 call, and we can use that proceed to help finance a November with 94 days to expiration in the money $35 call option. So altogether, this would cost a trader about $6 a share or $600 a contract. So the whole objective here is obviously the stock to go higher because you're basically long a debit position, but it gives you flexibility as long as the stock doesn't breach above the 4250 by the September expiration at 31 days, to which point after that the profitability is unlimited potential. Ideally speaking, you'd like to see the stock to at least $41 by the November expiration in 94 days. But the maximum loss is the money outlaid in this case, which is $6 a share.
All right, thank you for that. And the hopes on that trade is that it heads a little higher. Thank you so much, George. Great to see you. Appreciate it.
Okay, Nicole.
All right, coming up, our 360 round will focus on the fallout that's been happening and the devastating wildfires in Maui, the impact it's had on the markets. Our panel weighs in after this.
When traders tell us how to make Thinkorswim even better.
So with my small account challenge, I'm kind of starting to do. It only allows me so many trades per day. I'm using a cash account. I run out of cash. wasn't paying attention. I really only have one more trade after this. So I have to start looking into that at the time and how much buying power I have left. Try and slow my trades down, which should help me anyways. Not trade as much. Only trade the perfect setups. I am liking this short here though. Still. In the meantime. Move back to VWAP would negate it. Below there on barbecue, down 5.6. I'm out. Dang. Final trade. Not even noon yet, so yeah, way too much this morning. The unsettled cash and sell tomorrow. That's true. But no, not with a cash account. Cash account won't even let you buy. You can only buy with settled cash. But yeah, if I see a really good trade setup, I can cheat and use another account. But I'll try not to do that. This will help.
And, you know, again, the biggest tragedy about this fire were all the lives. It's actually probably going to go down in the record books as the deadliest wildfire this century. The Camp wildfire in California, unfortunately, which was a record-setting wildfire, 86 people lost their lives. The death toll from the Maui fire is almost 100 people. So that's just, you know, it's terrible. Insured losses from this event look to be manageable for the industry. One of the rating agencies put out an initial estimate of $1 billion of insured loss estimates. Our sense is that number is going to climb. And FEMA estimates that the rebuilding costs will be about $5.5 billion. But this is a manageable, from an insurance perspective, it's a manageable event. What it does, though, is add, and this is a terrible pun, fuel to the fire for insurers to pull back from wildfire-exposed areas. We're seeing that in California, Colorado, and in other areas that are prone to catastrophes like Florida. What remains to be seen is whether or not Hawaii gets lumped into that category.
Yeah, and you know, it's interesting because the whole idea of insurance is to battle these things, but for example, you can't get flood insurance in areas that are always flooding, and if you're in a high area for wildfires, it's going to be the same thing. Let's talk about some of these utility companies. I mean, there's so many here in the U.S. I mean, you know, you think about Exxon and Travelers, and you know, there's so many as we talk about this, Andrew. Your thoughts on the group overall here at home? You have Duke Energy, Southern Company, Pacific Gas, American Electric, DTE, NextEra. Any thoughts on some of these names? Con Ed, of course, a big one.
Yeah, right now we think utilities are relatively attractive. They had a banner year last year. They outperformed the market by almost 20%. But it's really a flip this year where you're seeing utilities underperform.
Yeah,
and
utilities
so
are
we
so
like
expensive.
the utilities where we have strong confidence in the underlying growth, as well as a good dividend yield. So we like Duke Energy, as you mentioned. We like AEP, but we also like Entergy, ticker ETI, and NiSource, ticker NI. And those are our 4 stocks that I mentioned that have very good growth, good dividend yield, and growth, we think, just beyond this past 5 years for underlying infrastructure, but also kind of this clean energy transition.
Whoever talks about AMD.
Right, understood. And Kathy, in the world of insurance, do some names seem to be leading the pack and doing well for investors? They can watch them?
Yeah, I mean, I'm actually pretty positive on the insurance and the reinsurance space, the property casualty insurance and reinsurance space. My top pick in this space is Arch Capital. It's a Bermuda-based insurer and reinsurer. Yeah. It's just done a really good job underwriting and leveraging the pricing strength that a lot of insurers are enjoying right now. I have a positive bias for the commercial lines market, largely because those carriers tend to be more diversified. A lot of the personal lines writers, like Allstate, for example, where we have a hold, are concentrated in auto and homeowners, which are bearing the brunt of all of these catastrophe losses and claim cost inflation. So my bias is on the commercial line space. I also like Chubb. I think they're a decent underwriter. The stock is pulled back, and that's an opportunity. They also have a very strong balance sheet. I think Travelers is a very astute underwriter. They're not growing necessarily as fast as some of their peers, but they've done a very good job managing the book of business they have. And then the other thing is, for investors who don't want to absorb the risk of claim costs, you could buy an insurance broker. And my top name in the space there is Arthur Gallagher.
Yeah. It's great to talk to you about all this. I know Dino Giordano, the chairman of Arch Capital Group, which is funny. So I'll be happy to hear that you picked it. Thank you so much. It's great to see you both. Andrew Bishop of Morningstar, Kathy Seifert of CFRA. Really appreciate you both being here. Big story. Thank you very much. That's going to do it for us here on Trading 360. I'm Nicole Petalides. I'll see you at 2 p.m. Eastern for the watch list. Join me then. Fast Market is next.
No NVIDIA and exhaust. That's true, it's no NVIDIA exhaust. I'm such an idiot. You were short, it was 3? Are you serious, Kitty? Been trading a long time, man. Been in the market for a long time. I'm assuming it wasn't 3, that's after a split, or before a split. 2016? 10 years ago? Yeah. Sell low and buy lower. Buy high and forget about it. Genius. I think we're back in the sell low, buy lower. We're getting back into that. I think it's for deep value right now. How long you have to wait for it to be appreciated? Market's turning around. If it's trying to swim upstream. Yeah, GNS is consolidating nice. Keep SPY can hold above VWAP here. Do it. No, SPY. We're going the wrong way. Out of my final trade. Wah, wah. I don't like trading around VWAP. It just wants to sit there, dance around. Not very often we see it. If it's on a trend, it just keeps going through VWAP. Not low, but it doesn't go lower, sell low. Well, a mistake this morning, which would have made today better, was I was trading tomorrow's contracts. So I was using the same amount of capital, but for tomorrow's contracts, so it's fewer contracts. Of course, they're not going to move as much. There's the break on SPY to the downside. And that was so far the best move today. Second mistake was build my buying power too early. Still could be good trades like this one right here. Potentially. Maybe get a bounce here. First a flush.
And bottom line and reaffirming that rather muted outlook. This has been the year of moderation for Home Depot after explosive pandemic growth. And I would say that these numbers and the outlook pretty much reflect a year of moderation. But let's run through them. EPS of $4.65 came in ahead of estimates of $4.44, although it was lower, as you can see here, than the year-ago period. Revenue fell to $42.92 billion. That edged higher than
unpredictable
what analysts were
massive
expecting,
leverage
around
positions.
$42.25
If it was
billion,
unpredictable
was a
and it was
decline from the
massive,
year-ago period.
wouldn't that be
Store
also
sales fell 2%
look like
in
a
the quarter.
crash?
It was the third quarter in a row for falling comps, but still better than analysts were expecting. I was seeing estimates closer to a decline of 4% there. CEO Ted Decker said there was strength in categories associated with smaller projects, but did say they see continued pressure in certain big-ticket discretionary categories. So breaking it down, comp sales of items priced more than $1,000, so think patio furniture, grills, appliances, those fell 5.5%, but sales were positive for things like plants, landscapes, hardscapes, that type of things. Pro sales were slightly negative in the quarter, but did outperform the do-it-yourself customer. And Home Depot says surveys suggest that pro backlogs are lower than they were a year ago, but they're still at healthy and elevated levels relative to historical norms. And they said projects in those backlogs are generally smaller in scale and scope. Smaller in scale and scope obviously would mean less expensive. So definitely an eye on budgets here. Home Depot reported Q2 gross margins of 33%. That was down 8 basis points year over year, due mostly to shrink theft, which we know a lot of retailers are struggling with. It's been a consistent pressure for Home Depot. And then in terms of that affirmed full-year outlook, EPS of down 7 to 13%, revenue down 2 to 5%, and comp sales down 2 to 5% for the full year. So still continuing to see declines. Didn't make any adjustments to those outlooks, so didn't get any better, but also didn't get any worse. So I think that that's kind of key. And also they did say that the first few weeks of Q3 are actually looking a little bit better than the first half comp. So potentially seeing an uptick in July, just like we saw with the retail sales number earlier this morning.
Caroline, I'm going to give you my theory on why I think the street is getting Home Depot wrong. You tell me where I'm off base. I think that higher interest rates are keeping people in their homes, which will create more need for doing either small or big projects. And you're right, they reported more small projects, less big projects. But the comps is what's really hurting Home Depot. And when you come off a blockbuster year like they had, if you can get anywhere near those comps, it should be really positive for this company going forward, right? What am I getting wrong here? Anything close to the massive numbers they put up before should be good for this company over the long run, Caroline.
Yeah, I'm actually surprised that we aren't seeing any more of an uptick from Home Depot based on the fact that yes, they did see declines, but it actually came in better than expected. And we haven't seen the Home Depot's stock actually really outperform this year. It was only up about 4% year to date heading into this report, whereas Lowe's is up a little bit more. So you could say that the bar is set a little bit higher. Yes, a weak housing market might mean that homeowners, and high interest rates too, might mean that homeowners stay in their homes and remodel versus move to a new one. But I think we also have to just remember that so many homeowners did all of those projects during the pandemic, and they don't necessarily need to again. But also because interest rates are rising, people are less likely to spend a lot of money on some of those projects that would actually be bigger ticket projects, and that would also benefit Home Depot.
All the money in the system is fake.
They obviously make
more
on
derivatives
appliances than they do on plants.
far
So
outweighs
I think that's something else to consider.
equities.
But I don't think this is a bad report. Home
That's
Depot
fake.
itself calls this the year of moderation,
And
I think these are
all of our
companies that
money's
we're
fake
kind of
anyway
used
since
to
we've
being
left the gold
slow
standard.
and steady. I think maybe
Right.
we've just gotten kind of used to some of these tech responses, like the Nvidia's up
Look at it that way.
200% year to date, that we forget that the Home Depots of the world are a bit slower and steadier. I should also note that they did actually also authorize a new $15 billion share repurchase program effective August 15th, effective today. It's not giving the shares a boost either, but returning some money to shareholders as well.
Yeah, I think also one of the concerns we have to start thinking about moving forward is the housing market did a top out. You saw that housing market index dropped to the 50 level, down 6 points from last month. That'll be concern for a lot of these home improvement stocks also with those headwinds and higher interest rates also. All right, thanks to Caroline Wood, Senior Markets Correspondent here.
Is investing in the home builders despite these high rates.
That's right.
So
Maybe
I don't know if he'll agree with that.
Maybe he's late. Maybe he's late, Caroline. Maybe he's late. He's been wrong before. All right. Thanks to Caroline Woods for bringing us that story on Home Depot. But now let's bring in Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. Hey, Randy, give me your take here. I mentioned this to Kevin. It seemed like everything was going smoothly through the month of July. We're starting to see some rough waters here. S&P 500 down about 3% so far this month. Are we starting to see those little stories start to add up here where maybe the economy is not as strong
GNS is now
as
down
we
3
thought,
1/4.
but then on the back of that, besides China, Fitch coming out on the banks, on the other side, we've got retail sales up 0.7. Is that probably the top that you're going to see for this market in the near term anyway because of those rising interest rates?
Well, that's kind of the challenge we have is we've got this conflicting data, right? I mean, we had the market up about 18, 19% year to date, at least the S&P was, and it kind of makes sense that we would have a little bit of a pullback. We know that the market does not go up continuously. It stair steps up. It's 3 steps forward, 1 step back. We were way overdue technically, and we've talked about this a number of times for a small pullback. I'd still expect this pullback to be less than a correction. I've mentioned it probably 5% perhaps, and we're probably pretty close to that right now. That's a healthy thing overall. Yes, the economic data is not great, but it never really has been. And that's the argument that people have been making all year is the fact that the market was ahead of the economic data. That's pretty normal, though. The S&P 500, the market tends to run anywhere from 6 to as much as 18 months ahead of the economy. So if the market gets way ahead of itself, which I think it has, the economic data needs to catch up. When you see a little bit of a softening, that's going to bring things back down a little bit. And we know historically, the month of September, and I know we're not there yet, but it's a terrible month. August isn't a spectacular month either, typically. We've had September down in 4, I think, of the last 4 years, and it's the only month in the long term that actually has a net negative return. So that doesn't bode very well for the next 6 weeks. But this generally will represent some sort of a buying opportunity, I think, again, for small positions, for people who have a relatively long-term outlook. I still think the net movement overall between now and year end is probably going to be higher.
Of court
but I don't think there's any way it's going to be
relying
as high
on
as we
corrupt
went
judges
the first
though.
half of the year.
Great.
Frankly, if we get say 5 or 6% net
Don't
gains
tell me
in the
right
second
now.
half of the year, that would still be a pretty
I
positive year.
traded
We'd
up
end
and down, but we know
more
it's
than
going right.
20% higher. That's not too bad. But it kind of makes sense. We knew China was softening all along. Then we have these new restrictions from the U.S. about what companies can buy and sell and trade with China. So that's going to be a little bit of an issue. The geopolitical tensions are only rising. They're not getting any better. So all of those issues are coming into play. And really, earnings have just been a little slow catching up to the market. Now, keep in mind, Q2 earnings season, which is pretty much over now, was expected to be the trough for the year. The outlook for Q3 is better. The outlook for Q4 is even better yet. For earnings, they've come down a little, but they're still going to be far better than what we've seen so far. And, I mean, get this. How crazy is this? The Atlanta Fed GDP Now update today, 5% forecasted GDP for Q3. Now, I don't think anyone thinks that's really going to happen, but it's hard to imagine it's not going to be something over 2%. That's still not a bad economy overall.
Yeah, that's interesting, Randy, because I remember last week we talked about that, and we were all surprised that they had gone up to 4% last week, so jacking it up another % here going into this. But Kevin, when you look at the news out of Fitch here, this is the second rating agency after Moody's last week with the regional banks kind of hitting them, coming out with this warning. And, you know, that's, I think, what people are kind of grasping a hold of today is that why are they coming out with these warnings? We've got good retail sales, GDP numbers are going up, the jobs market's strong. Give me your take here.
Well, remember, first thing, this is just a warning. They said if they were to lower the U.S. debt from AA plus to AA minus to A plus, they said it would, here's the quote, if we were to do that, it would recalibrate our financial measures and would probably translate into negative rating actions. And they mentioned 70 U.S. banks. Now, Tom, there. Remember, that's an if they do it. But, Tom, here's the thing. Here's the problem with what they said. One of the things they targeted was federal debt levels. Anybody see those going down anytime soon? The answer to that is probably no. So what will eventually lead them to do that then? And so, remember, I'm sure you'll see leaders like Jamie Dimon, because they included J.P. Morgan in that report. I'm sure they'll come out against this and say our balance sheets are good, our risk measures are fine. You know, they'll go through their talking points, but no one who can argue, raise your hand if you can argue with the U.S. debt levels that are probably too high and higher interest rates and maybe an economy that doesn't slow down as quickly as we thought. If the interest rates have to go higher, remember, that makes our debt payments, our debt service even more and more expensive. So I understand their point. That's one of those topics that's been pretty much ignored by the trading community. So, you know, and that combined with some weakness out of China, someone we depend on a lot for a lot of the variable demand in our commodities and in our products. So things, remember, we talked about, what could possibly come up on the calendar that might cause the market to sell off. And here's one last thing, guys. The first half of the year, what was one of the factors why the market rallied? Because everyone was negative, right? And the market rallied. Now, people are getting much more positive, guys, and that is the counterintuitive reason why the market may soften.
Yeah, that fear and greed index peaked out a couple weeks ago, right at the start of August, and we've seen some pain since then, so maybe that contrarian trade working out once again. All right, guys, let's take a quick break. When we come back, we're going to continue the earnings discussion. We're going to take a look at Target, the big box retailer. Has struggled so far this quarter amid changing consumer trends and inventory issues into earnings tomorrow morning. Fast Market's coming right back.
I don't know. Buy TUP. We should probably buy TUP anyways, right? TUP's down 7. Nice, Bubba. All in on sheep. I heard that was rallying the other day.
of a really good company going through a tough period in their history. And you know, they had that big inventory miss on discretionary products, which has frankly caused a pretty long hangover, a lot longer than people thought about. And the fact they had to bring their margins down to clear out that inventory. Well, the management is reporting, and I would expect them to report more on this now that the inventory issues are a thing of the past. Their margins are going back up higher because they're through the inventory. Their current management says current inventory levels were down 16% year over year. That's good news. If they can, you know, make a report that their inventory levels are low and their margins are going back up, and all they need is this stock or the news flow out of this company to firm up, and I think things could get a lot better for them. This is a good company going through a horrible news cycle, but that said, Walmart has recovered from the same problems Target didn't. That's the most interesting story of this week with these two companies, is how much Walmart has rallied, how little Target has, guys.
Yeah, and you know, they had the issues a year ago on inventories. They're trying to fix that, and now they've got consumer trends changing a little bit, Randy, where they're moving away from those discretionary items. Essential's still doing well for this company, but they expect a decrease in comparable sales. What's your take here on Target?
Well, I think one of the challenges and one of the mistakes people make regularly is they compare Target and Walmart, as Kevin just did. They're not exactly the same. When times get tough, there will be people who move to Walmart who don't typically shop there. When people at Walmart are feeling pretty good, then they start shopping at Target. Target sits at a tier that's just slightly above Walmart. Walmart's sort of at the very bottom end. They may compete with people like Dollar General and dollar stores and people at the very low end whose primary concern is cost. Target, I think, positions themselves and really always has at just a little bit above that level. So when we see the economy doing really well, when the labor market
GNS
is
coming
strong,
down, it's down 5%
we see a lot
now.
of economic expansion, Target does tend to do better. Well, we haven't been really in that kind of a mode this year. I mean, right coming out of the pandemic, when people were buying goods, yes, they were shopping at Target because people were shopping everywhere they could to get their hands on things. But now that we know interest rates are high, we know that people are pretty much tapped out on all their free cash and they're starting to spend on their credit cards, which now have higher interest rates because of the interest rate environment we have. People are starting to pare back on actual physical items. They're still spending on services and travel and things like that. But actually goods, as we know, have come down, and people are paring back a little bit on that, or they're finding lower cost alternatives. The lower cost alternative to Target is oftentimes Walmart. So we should not really look at those two as being in the exact same tier, and I think that's some of what has caused some challenges, I think, at Target. I mean, as you said, when you've got a year where we're up 17% by mid-year and you've got Target down 15% year to date, that is a really long hangover, as you said, Kevin, and it doesn't seem to really show a whole lot of signs of getting a lot better at this point.
And Randy, you got an example trade for us. Option markets elevated at this point as far as implied volatility going into this report. How do you want to look at this one?
Yeah, so again, we're trying to find an example. I'm always looking for something interesting that sort of might go with the narrative. It's not my personal opinion, but let's just say we talk about what we just mentioned about Target's been having a little trouble, the fact that it's down more than the market overall and underperforming. It may be in a position where it could potentially rebound in the latter half of this year if things continue to get better. If we get anywhere close to the GDP estimates that we see from some of these forecasts, maybe it's hitting a bottom. But we've got an earnings report coming out, right? We know this is happening tomorrow. So one of the things that you might be able to play if you're thinking things are going to stay a little low for a while, and as we talked about earlier, August has not been a great month thus far. September, maybe not even any better. So maybe things are going to trough for a while and kind of go sideways, and then perhaps there'll be a little bit of a recovery after that fact. If that were your perspective, then you might look at something like a calendar spread. So I put together an example here of a call calendar spread. This example, we're looking at the stock, which is around 126 and change right now. In the near term, so by the end of this week, which will be after the earnings report tomorrow, if we sold a 135 call that expires at the end of this week, that one's out of the money by about $9. So it would have to have a really sharp spike on earnings in order to get to that point. But then if you go out about another 5 weeks or so and look at the 9/15 135 call, that's a relatively expensive option. It would cost you almost $3. But if you did this as a calendar, you can reduce the price of buying that 135 call to only about $1.10. So when you do this kind of strategy, you're expecting that the stock will stay below 135. So you could still get a pretty good up move on this earnings, just not a $9 move. It stays below 135. By the end of the week, that short-term call will expire worthless. And then you'll be sitting on the long option that's worth about $3, but you can get the whole trade in for about $1. And because of, as you said, as you often see, just before earnings, the volatility starts to go up, and it tends to affect the near-term options in a much greater way than it does the long-term options. So you're selling an option whose price has been jacked up by the implied volatility, and you're buying one whose price has been very minimally affected by the increase in implied volatility. So selling relatively expensive, buying relatively cheap. And this is essentially a 5-week trade or so that you're trying to bring the cost relatively low. If you then get an up move in the market, you've got unlimited upside after this week's expiration, and your overall risk here is only about $1.10.
All right, let's break this one. Example trade down, buying the September monthly September 15th, 135 strike calls, selling that same call in the August 18th cycle that expires in just 3 days. You're paying a debit of 110. There's your risk, $110 per spread on that one. But your break even's pretty wide on this one, Randy. Just above 120 and about 153 on the upside. But at the same time, it's probably tighter, maybe 123 up to 150. So you still have a nice wide range. And I think the divergence in implied volatility, you're buying basically a 40% implied volatility on aggregate in that September cycle, selling about a 97% in the near-term options. So that's why the cost of this calendar goes down. Now, you do have some assignment risk on that short 110 call that expires on Friday, but you do have that ability to roll or adjust that short strike as we get closer to expiration, because this is a positive time decay type trade where that short option that you're short in the August 18th cycle decays at a faster pace than the long September option. So basically a 1 month wide call calendar to the upside. Option market's priced in about a plus or minus $9 move in the shares either way on this one, but this is definitely takes advantage of maybe that one standard deviation move to the upside in here. You do have that ability to roll that short option on a week-to-week basis if the market's open, liquidity is provided also. But a good look at a call calendar, low-cost entry point call calendar to the upside, taking advantage if the stock does move higher post-earnings. All right, that's going to do it for this segment. Thanks to Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, for joining us. But coming up after the break, Kevin and I are going to be joined by Landon Swan from Likefolio for a discussion on TJX. The parent company of TJ Maxx and Home Goods reports earnings tomorrow morning. The stock is just off of all-time highs it hit last week. Stick around. We're coming right back.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the market.
ETOO breaking out there. Breaking a pretty big resistance. 42% on it. Like SPY probably wants to retest the lows today. I'm out of trades. Had my put. guess a bad entry. I like the entry, but shook me out. But now it's setting up better for that flush. %42 there on TTOO. A saved 24%. Apron's up 8. Any recommendations today for viewers like you? As far as stock picks? Stocks to trade? I like GNS still. A consolidation right now, so that's bullish. Good. It's not a dip buy. It's a buying high and hoping it goes higher. Buying high and selling higher. Daily SPY puts. Close them out at 443.50. GNS is more of a swing trade. TTOO you could do some scalping on. All sorts of ways to make or lose money in the market. ABNT to the long for a swing. I've been averaging into this one last week. LQR. This one, this is probably the lowest one on my hype list. Especially now it's made this head and shoulders.
If I'm leaning bullish, which is what we are. So yeah, I like TJX here. I think that there's a pretty low chance that they disappoint on this earnings report. And frankly, you know, some of the premium that I'm seeing in the market seems a little high. So I'll probably be a premium seller, like I'll be maybe selling some puts or something like that. I just don't see them disappointing. I don't know if they're going to break out, but I would think that they're going to, you know, be either within that 86 to 88 range or maybe just a little bit higher.
You know, Landon, their business model of being an off-price retailer, it works in good economies. It works in bad economies. They were a post-COVID winner. They were a Great Recession winner. Correct me if I'm wrong, the only thing that can hurt this company is when you absolutely have to close the stores and people aren't allowed to walk in their brick and mortar locations. Besides that, their business model works in good and bad economies. They're expanding. They keep growing. Now they're growing internationally. I mean, this is a company with a business model that just works. They do off-price. You get quality apparel at off-price, you know, off prices. What am I missing here, Landon? I mean, as long as the doors are open, they seem to be doing extremely well.
Yeah, I think you're right. I mean, no one in management could have seen that coming, and they handle everything else really well. I mean, they have executed very well, and you always want to bet on a company that can execute really well. You want to bet on a company in a good industry, that has a good model and all of that. But management and execution is very important, and they have shown the ability to navigate tough waters and excel. And this retail report that just came out showing a pretty healthy consumer who's still motivated by deals. And so the deal seeker is TJ Maxx, right? That's where they're going. So as long as that exists, I think the only environment where they might struggle is in just complete abundance, where everyone is doing well and nobody's worried about any prices whatsoever. And I hope I see that in my lifetime, but I'm not betting on it. So over the next 20, 30 years, there's going to be people for sure that are motivated by deals. That's their model, and they're executing very well. So yeah, I like this company long term. It's not the sexiest name out there, but they're just cranking along, doing their thing and making money. And that's always attractive as an investor.
And Landon, even with the stock up, it's only up about 7% this year, but it didn't have that big dip. So it's, just below all-time highs. What kind of score do you have to going into this one? Do we have to be cautious?
So we're plus 28, which is in the solid bullish territory. Usually 20 is the cutoff. And I kind of go back to what I was talking about earlier. I think that when you look back at some of the moves that it's had over the past several reports, it just doesn't move a ton. But there's a little bit higher move priced in right now. So I think the premium is unjustly high. I would lean into maybe selling puts or doing some kind of vertical on that side, like a bullish vertical where it doesn't go against you, something like that. I'm not betting that this breaks out and we see like 92 tomorrow. I don't think that's realistic, but I think it's likely to either stay in the channel or maybe bump up against that 88 and push a little bit higher. So I don't see it going down to 84, 83. So I think that they're going to report numbers that satisfy investors, don't disappoint, and just show that they're cranking along. And that's fully what we expect. That's why we've got a plus 28.
All right, great stuff as always, Landon. Appreciate it.
Thank you.
All right, that's Landon Swan, co-founder at Likefolio, breaking down the data for us here on TJX and earnings. Kev, kind of muted move going into earnings, only plus or minus just over $3.20 either way in these shares going into this report. How do you want to look at it? Landon thinks that implied volatility elevated in here, and as I mentioned, just below all-time highs.
Likefolio's data, Tom, and Landon's opinion fed exactly into the trade that I was looking at, which is a slightly bullish trade, but one that sells premium. And what I did, Tom, I did the iron butterfly, which means I'm selling the straddle, but hold on, I sold the straddle $1 higher. I sold the $87 straddle, and then I bought the wings to make a $4 call vertical.
Does TUP actually have earnings today?
So I sold the 87 straddle, bought the 91 calls, and the 83 puts, Tom. I'm collecting about $2.60 on this package, Tom. And so if Landon said like $88, that's almost perfect for what this is looking for, because all we're looking for is the air to come out. A slightly bullish move that, remember, the stock's already run quite a long ways.
It's
so
estimated on NASDAQ site to be out
maybe
tomorrow.
A muted response to that good news would play very well into this type of a trade. And if something does happen out of the norm and there's a catastrophic move, you are risk defined. You're risking about $1.50 to make $2.50. Now, full disclosure,
that's an estimate,
not going to make $2.50. Right, you'd be looking to make
consistent with other estimates.
A small amount of money.
They haven't
and
announced
then
yet.
Cover these, because one side of that 87 straddle is going to be in the money, right? So you do have to. This is a trade, Tom, that you do have to manage post-event.
Barbecue down 2.6.
This is one that plays for just a slight drift to the upside and very little movement besides that, Tom.
Yeah, let's break down this example trade here. August 18th, monthly cycle. So only 3 days till expiration here, Kev. You sell the 87 call, sell the 87 put. There's your short straddle. And then you're buying
the
a
bath again,
strangle against
Bubblicious?
that to keep it risk defying. You're buying the
Love that bath.
87 or the 91 strike call and the 83 strike puts. As you mentioned, the wings are $4 wide on this, collecting a credit of about 260 right now. So that's your max potential gain right at or near the 87 strike. $140 in risk per spread, and that's outside of 83 on the downside and 91 on the upside. So pretty decent risk reward profile. Break evens on this one, 84.40 on the downside, 89.60 on the upside. And as Kevin mentioned, one of these short, either the call or the put on the 87 strike, will be in the money. So if the market's open, liquidity is provided, maybe you close this early. But the idea of this type of strategy is it stays between those break evens. You'll see time decay or theta work in your favor. Implied volatility historically falls post earnings after that event risk is gone. So this would decrease or contract in price if it stays between that 83 level and 91 level on the upside. So pretty good look at a short iron condor, or sometimes referred to as an iron butterfly here, because you have that short strike on that same strike, the 87 level here on that example. So keep that in mind also. All right, let's take a quick break. When we come back, we're going to take a look at JD.com, which is down over 36% so far this year into earnings as the Chinese economy continues to get hit. Coming right back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Schwab Network's like no other financial media you've watched because it's all markets, all the time. It's 100% finance. We look at everything as traders and investors, and everything we say, everything we do is through that lens. There's no ulterior motive, and there's no subjectivity. There's no random guesswork about what we think. We are following the numbers all the time, relentlessly. We have the best CEO interviews, hands down. They're long.
All right, SPY's coming down a little more here. Looking for this inverse cup to finish. AMC, new high there, up 6.6. See if it breaks that 36.40 high from before. Starts filling the gap.
6%, underperforming. Some of the other e-commerce players out there like Alibaba and PDD, which is basically Pinduoduo, which really focuses more so on agriculture and food versus JD.com, which focuses more on electronics and, of course, durable goods for the household like appliances and so forth. But one of the things about JD I noticed is if you compare the charts of these stocks to each other, the underperformance of JD doesn't surprise me because they have very low gross margins, about 8.5% of sales. If you compare it to Alibaba, you know, that's significantly lower. They have about 37% gross margin. So one would say, what gives? Why is that the case? It appears to me that JD.com has actually deployed a lot of capital, particularly in the last couple of years, to build their logistics business, because they're not just e-commerce, they're really a logistics giant, while at the same time, they're building out their supply chain technology business that they're selling services to other third-party retailers, merchants, and so forth. So they've been spending a lot of money to build out their business, and I think that's one of the reasons the stock has been underperforming. Now, looking at the report, they're actually going to be reporting tomorrow before the bell. The estimates for earnings are around 73 cents. Now, that's about 19% higher than last year's 61 cents. But if you look at sales, they're expected to come in around 39.25 billion, which is just fractionally higher compared to last year's 39.15 billion. So the bar is set very low for JD. I think the Chinese stocks right now have not been trading well at all. I think the U.S. dollar is something we have to keep in mind. As the U.S. dollar starts to rise, that's going to put pressure on emerging market equities from a bigger picture standpoint. But I think, you know, overall, looking at the trend for JD, you know, if you look at the 10 and 20 week moving averages, it's really just sort of drifting sideways respective to those. And that, again, doesn't give us a directional bias either way, because the stock in the last few quarters has basically been in a trading range.
And some of the competitor taken away from them, Pinduoduo's growth was pretty strong last quarter also, but this one's been taking it on the chin. I could easily see, if they report some decent numbers, I could easily see this stock popping just because it's been under so much pressure, but we'll have to wait and see on that. All right, thanks to George Tillis, Senior Markets Correspondent. Kev, I wanted to get your take here on JD.com. You know, it's got that China backdrop to it, right, where we might see some disappointing numbers just due to the fact that the Chinese economy hasn't rebounded as strongly as everybody expected.
Yeah, remember the zero COVID policies that the Chinese government put on some of these tech companies have affected different companies in different ways. And it looks like to me, partly because of that, partly because of they're getting some e-commerce competition, that they haven't recovered from it yet. And their sales slowed, their growth slowed in the first half of 2023. So this stock's under some pressure. They've got competitive problems now, and just look at the pricing of the stock. It's struggling here to get any real foothold or any rally. So this is a company that in this earnings, they need to change the tone that surrounds this name right now with everything going on in China and their inability to get going here. Yeah, this stock is, you know, the chart reflects the attitude about this name, Tom. It's under pressure.
Yeah, and that's kind of the way I wanted to look at it, Kev, because implied volatility, while elevated going into this earnings report, IV percentile rank only about 19%. So it's not like, you know, they expect an explosive move. It seems like volatility is muted, and that's a strategy I kind of wanted to look at here that takes advantage of a directional bias if you have it, but also because implied volatility maybe not that elevated. Option market's still pricing in about a plus or minus 6% move in the shares, just over $2 either way. So, Kev, I looked at a strategy that basically directional. It stays risk-defying going into earnings, but takes advantage of a move to the upside if you believe that this stock's going to rally post-earnings, but also giving myself a little duration, so it's not a pure earnings play. So looked at the September option, so 31 days till expiration, buying the 35 strike call, and then against it to offset some of the costs, because if you think it's going up, maybe it doesn't explode up past 30 or 40, excuse me. You pay a $1.80 debit for that. That's going to be your risk on this $5 wide bullish call vertical. with the opportunity to make 320 if it goes above 40 at or near expiration on that one. So Kevin, risk reward seems pretty decent on this. You're risking 180 bucks to make 320 on this one. Your break even 36.80 to the upside. Kevin, that's only about 80 cents above the current share price, so you don't need a massive move to the upside. Your thoughts here on the directional call vertical?
Yeah, you're buying an in-the-money call by just under $1, selling a call $4 out of the money, paying about trading about 185 right now, right around that range. So you don't need a big move on the upside for this to get through their break even. So yeah, this is a $5 vertical, not really paying any serious theta levels. You're long about 34 deltas. Why? Well, you bought an in-the-money call, sold an out of the money. So this is just a bullish play going out till September expiration. So about 4 weeks away from where we are right now. It's a 34 delta long call vertical, Tom.
Yeah, and you only need just over a 2% move to the upside to get above that break even. But buying verticals, you also have that opportunity if the market's open, liquidity is provided to close it early if the stock does pop on that. Kev, real quick here, we only got about 30 seconds. Your take here on the markets, we're still under pressure. S&P 500 down about 0.9%. What are your thoughts here going into the end of the day?
Yeah, this market looks heavy. It's mid to late August now, and there's no real this China headlines that continue to drift over this market, and the overall economic news from Fitch. This market's heavy right now, Tom, and there's not a lot of high-profile names to change, other than NVIDIA, to change some of the narrative.
Yep. VIX back above 16, up over 8% on the day with this uncertainty. All right, that's going to do it for Kevin and I today here on Fast Market. But stick around right here on the TD Ameritrade Network. Next Gen Investing is coming up.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing.
You should have a plan before you bought them. Have a plan before you enter. Then even if you stick to your plan wasn't good, you'll still have more success than someone that didn't plan. GNS is down 2%. ETLO 51%, still breaking out. HCTI is up 26%. Blue Apron is at 10%. AMC, new high there on AMC. It broke the high from the other day after the news.
Collectively, we are just seeing right across the board today.
Yeah, it's been a little bit of weakness here so far. Jenny, we'll see where things shape up. Every single day, it seems, has been a movement away from the unchanged line and then kind of a fight back towards it. Today has been a little bit different script. We've been weak all day, continue to be weak. We'll see if we can push down to new lows on the session. But right now, S&P's down 40. It's a pretty big down move. NASDAQ down about 110. It's obviously been a weaker period of time for the market the last couple weeks, but in large part we haven't really gone anywhere. A couple more days like today, if today ends up being as weak as it is right now, can certainly change that script.
Yeah, I think that's a really good point to point out that we really haven't gone anywhere, but obviously today I think then gives a lot of these bears some fuel and momentum. But as always on this show, we'll be kicking things off here with our upvote and downvote segment, focusing on more of the individual stories that are moving markets today. Then we will be discussing our FOMO segment. That's all things Target ahead of their earnings event, which is expected tomorrow morning. We'll look at Brinker as well, which also is expected to report tomorrow morning. And last but not least, our under 30 name today is Ford, as we did actually get some pretty positive news out of Morgan Stanley standing by their overweight rating on shares despite some looming headwinds of a strike with the big three autos.
Yeah, tons to explore here today. Looking forward to the conversation on Ford. At the end of the show, of course, Target's going to be a big centerpiece for today's show as the FOMO segment. We know it's a very retail-heavy earnings week. But as always, Jenny, let's do upvote, downvote, not endorsements, not recommendations. Excited to go through these names. Not a huge theme once again, but should be a good conversation.
Yeah, so we'll start things off here with, I think, the biggest move to the downside of the day, at least on our show. That is C Limited, now pacing for its record percentage decrease, I mean, of all time since the company.
Premiums are so high on AMC, they're not even moving.
Also, its worst two-day stretch on record. They're declining after the company's second quarter sales did come in below expectations. The Singapore-based company did report a profit of around $331 million, or around 54 cents per share. Compare that to a loss of around $1.67 per share they reported a year ago. Sales rose about 5% to $3.1 billion. This did miss the mark. Analysts had been expecting around $3.3 billion in sales. Bookings also fell, while their adjusted EBITDA did come in lower on a year-over-year basis. Quarterly active users were actually rising on a quarterly-over-quarter basis to around 544 million. Average bookings fell as well. E-commerce and other services revenue did increase around 20%, and their core marketplace revenue did rise almost 38% year over year. But I think all in all, just the fact that you have that sizable miss here on top and bottom line coming in so much below what the street had been pricing in. I mean, now we're seeing shares down 54% off their 52-week high. They're at 52-week lows here and now down 39% for the month.
Yeah, I mean, this is Netflix-esque in terms of the reaction. We really haven't seen this kind of price volatility in names so far this particular earnings quarter. This is a bludgeoning for C Limited as it just gets absolutely crushed here today, down 16 bucks, nearly 30% to the downside. Looking at sort of the numbers themselves, sort of post-earnings here, it's a miss, obviously, on the sales front. Net income was
relatively impressive, beating by a pretty wide margin, but really just not seen as enough here. This is a situation where, you know, if you're an investor in this name, these are difficult kind of days. But, you know, assess your positions, I guess, with the information that you have and make your decision from there. I mean, nothing you can do now with the stock down 28%. But not really much to add here to it in terms of that particular stock. Obviously, it's a very notable story, and it sticks out clearly with that kind of price movement here today. Next one on the list, though, Jenny, is Lyft. This is another story of struggle as of late, but doing okay today as it's up about 4%.
It is, and I was vying to talk about Lyft because all we talk about is the underperformance we've seen on the year. I mean, we have, frankly, it's up 10% now year to date, but just nowhere near Uber's near 80% rally. We have seen some weakness this month, down about 5%. Uber's down almost 11% month to date, but this name is our lone bright spot of the 4 up-vote downvote stocks. We did see shares rally after it was disclosed in a Form 4 filing that the company's CEO did execute a stock purchase of around 100,000 company shares for around $1.1 million on August 11th. Now, their chief executive owns about 12.4 million shares now in total. We also are seeing trading volume, I mean, around 13 million shares against the daily average of around 16 million shares. That was as of a few hours ago, though, so we did see morning activity exceed their norm here. This name, though, skews so much neutral among the analysts covering it. It's not even funny. I mean, 45 analysts, there are 33 holds in this name. There are 11 buys, and we do see the average price target now imply, I mean, some slight upside around 2%. But all in all, it seems like the street here is taking on a more sideline approach to Lyft, just given the disappointment we've seen in shares for the better part of 2023.
Yeah, and I think that that's a bit concerning when you consider the fact that it has done so poorly over the years and seems to be falling so far behind its key competitor and rival in Uber in terms of execution, in terms of market share, and of course in terms of growth, both financially as well as just in rides that it's doing. So for analysts to basically just be neutral on this, Jenny, I think really highlights the fact that there's just not much optimism. Normally when stocks struggle as much as this has, there's that perception that maybe there's some value there. The stock sold off a bunch. Maybe it's just due for a little bit of a bounce back. And I know about 20% of analysts are kind of calling for that. But at this point, this is a story where a lot's going to have to change in Lyft if it's going to be the company that it was sort of initially sold to the street as. It's been nothing but a disappointment thus far. What always sticks out to me is what we talked about last time we had kind of worked our way into Lyft's earnings, which is if you compare them to Uber, which I think you have to, Uber was a little bit cheaper in the 20 main markets, and it was a lot faster in terms of getting you to your destination because they pick you up faster. So you have longer wait times and you pay more for that. That's not a recipe for success, Jenny. Until they address that, it's probably going to continue to be a little bit of a question mark when it comes to Lyft. Next one here on our list, though, is EL, Estee Lauder. This is a pre-earnings look for a report due later on this week.
Right, so Estee Lauder does report their quarterly update Friday morning. We are seeing shares touch new 52-week lows, though, in today's session. We are expecting them to continue to post losses, expected at around 4 cents per share, which represents a year-over-year drop of almost 110%. Revenues are expected to be around $3.5 billion, which would be down about 2% from the year-ago period. Now, we did see a pretty negative report out of Citi warning on the near-term share price path for Estee Lauder just about a month ago. The firm did open a negative catalyst watch on the company due to concerns about their earnings report. They said they expect now consensus to be well below what the street is now priced, or they expect the earnings to come in well below consensus, and they believe this is being anticipated by the market, but they don't believe investors will view low guidance as conservative, just given the large cuts they've already made over the last 2 years. Now, an earnings miss from Estee Lauder would be relatively uncharacteristic. The company has topped consensus marks in the last 14 of 16 quarters. However, this sell-side confidence is fading pretty quickly. We have seen the last 23 earnings revisions from analysts to the downside, now moving the consensus earnings down almost 4% over the last 30 days. That's pretty significant here, just over the last 30 days alone. So this name also skews more neutral, a little bit more bullish here than comparing it to, say, like a Lyft. We do see 16 buys, 13 holds. The average price target, though, is still around $220 a share, which implies, I mean, over 30% of upside from here. So despite the lackluster performance on a year-to-date basis, analysts still believe in this name. This is actually underperforming the overall market. It's down 34% this year, down 9% this month.
Yeah, a lot of that's tied to what's been a lackluster reopening in China. It's so much Asian exposure as well for this company. That's considered to be sort of the spot to watch, as we are starting to see the travel markets pick up a little bit overseas in that part of the world with some of those bans falling off. We'll see if that can be a boost going forward. Comps are supposed to be a little bit easier as well. That could be a boost, but this is going to be a pretty, it seems, make or break quarter for this company after what's been a pretty disappointing run as of late in several quarters of declines. We'll see actually 4 straight quarters of organic sales declines. We'll see if it can return in its fiscal quarter 4 that we're due to get those results on this week, if it can bounce back into growth territory. Last one here on the list, though, Jenny, is PayPal. This is a company with a shakeup at the leadership roles.
Yes, finally, after many months, they did announce they were looking for a new CEO to replace their longstanding CEO, Dan Schulman, back in February. So he's retiring. We do know he will remain a director of the company, but we did get reports yesterday they were replacing him with Alex Chris, who's from Intuit. Now, we did see today Citi react here, saying that this next CEO does lift a key overhang and checks the boxes that investors were looking for. The analyst does think the gap between revenue growth and transaction margin dollar growth had already supplemented the CEO decision as the primary issue for these PayPal shares. They do view this announcement as a modest positive, but said the controversy in PayPal should continue here. They do keep their buy rating on shares with a $100 price target. This is above the average price target among analysts, which is about $86 a share, implies about 40% upside from here. I was actually surprised to see there's still 31 analysts that have a buy on this name, 15 holds, and I couldn't really find very many more bearish leaning ratings in PayPal, which is now continuing to steepen. It's selling alongside the broader markets, down almost 5% on the session. And this adding to the fact that it's down almost 20% this month. It's down 41% off its highs and just up a measly like 2.5% off its low here.
Yeah, and this might be one of those sort of buy the rumor, sell the news situations. I don't think this is the market necessarily being disappointed in this particular individual taking over. Obviously, the ties to Intuit and leading that company really kind of shows the focus that PayPal has had and will continue to have on trying to grow its small and medium business market. Intuit, very, very successful within that kind of small and medium sized business world. So I guess the hope is that this experience will bleed over into PayPal, but also just the uncertainty of not knowing what the leadership was going to look like. Potential losses of further leadership personnel could have been in the works without a CEO named and kind of in that spot. So kind of avoiding some of those concerns and fears as well. But yeah, obviously a little bit of weakness here today. We'll see what the long-term story is for PayPal, and we'll see how this new leadership team steers them in which direction. Let's try to narrow these down, though, Jenny. Obviously, I think all 4 of them are great choices. There's really no right or wrong answer here.
Yeah, and unfortunately, I think we'll move forward with the more negative story, although it's not exactly a positive story, obviously, in C Limited. But given the fact that we do still have Estee Lauder earnings on the horizon, being Friday, and PayPal's one, I do think today's move, we have to consider it was higher yesterday, so it's still only down about 1.5% for the week. So I'm trying to be optimistic here because all in all, these names are collectively seeing some weakness, not only today, but on the year. So we'll be looking more at Estee Lauder as well as PayPal for our 2 up votes today. Both names making sizable moves to the downside on the session, but we'll be breaking down the technicals with our chart master coming up next, as well as some example trades.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. with innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2.
Tasty. Thanks, man. Thanks for the trading fees, Dono. Like it. Trying to keep me healthy. Not having a coffee. I might still actually have a coffee though. Even though I'm sick. Got a little bounce around SPY. Didn't quite fully complete its cup. So chop sui, kind of similar to yesterday, and I made its move and then just trade in range. Today kind of inverse, made its move, and now it looks like it's kind of trading its range. See if we get end of day sell off like yesterday, or for a rip. What at this point looks like it's probably going to rally back up, maybe to retest VWAP, maybe to break out of the high. AMC is up 8%. Gotta pace my entries so I can have enough buying power all day. My favorite moves come at the end of the day. That's the thing, like, not end, but these larger, slower moves, much easier to hold and manage. By trading in the morning, sometimes you get some nice buffer in the morning on your account. You're up, so you can. But it's hard to just trade all quick how you do in the morning and then just pump the brakes and wait for the longer intraday setups to make present themselves. GNS is down 3. I don't know, I didn't see, was Jenny operating a lift? Jenny? I better be careful.
Jenny, that's been in a long-term downtrend. Even if you didn't know what the name was, you could see that 30-period simple moving average continuing to make that downward move. But I don't think that tells the entire story here. It's had some volatility, and it's had some periods of time where it has made runs towards those highs. At the same time, earnings tends to be a pretty gappy experience for this stock. At least the May earnings was pushing it really significantly below some major support levels. Now, that being said, it's tested another major support level down around this 175 mark, broke that a couple of weeks ago. We now get this little bit of a gap down into a hammer candle today. So it is coming up off of the lows. There is a little bit of bullishness going on. Potential there for a bounce back up to that 175, but that's been tested once, twice, 3 times from different directions here as a support and resistance level. So maybe it's a challenge for the stock to get back up through that range if it continues to move to the downside.
Also, is like a step above a thrift store.
A symmetrical move to the downside from where it is now, that puts you down around that 155 mark, but that's far from a guarantee. What's perhaps not the story necessarily that becomes evident here, and maybe this is when you wipe away the makeup and take the lipstick off the pig, is the RSI is diverging slightly higher. It's doing it in the short term for sure, it's rejecting that lower reversal line. But if you go all the way back to that May earnings announcement, it's diverging and making higher lows as price continues to grind slightly lower. And that would suggest that maybe investors' perception over time is shifting a little bit, priming the pump possibly for a reversal here, either at this point or maybe on the catalyst of the earnings announcement, guys.
Yeah, but I have to say that you spun that the absolutely most positive way here, because I was looking, I mean, just the move it made post-earnings last quarter back in May. We shed like $30 in this name on the session.
Right.
So this name moves on earnings. So also important to keep that in mind, obviously, here. But now when trading this name, with that in mind here, Alex,
You probably got them for cheaper than anywhere else.
Badly this year.
Those
like Ben did point out, we have seen some momentum leaning more bullish, but all in all, it's been a pretty brutal longer-term trend for Estee Lauder. So walk us through what you're
Hawaiian
thinking,
Electric
leaning
Industries
into a more neutral stance here.
is selling off from the fires.
Yeah, you know, Jenny, I couldn't tell you much about the brands
What
under the
the heck?
umbrella. I could read you their names, but what I can tell you is about 75% of the revenue is generated between Europe and Asia Pacific. So when you look at the international exposure of this company, it's quite substantial. The Americas segment has been one of the bright spots, at least in recent years, but we'll see if the Asia Pacific segment of its business can continue its recovery.
Electric
as it's
utilities
not been
and
the bright spot
they
that
have
it
a
once
banking
was
segment?
for the company. I looked at a more neutral strategy around this earnings event, seeking
That'd
to
be a good
sell
dip buy.
implied volatility into the event. You talked about its history of big price moves. Well, we're kind of leaning into that history and hoping that that isn't the case with this trade illustration, as this is one that is looking for a range-bound price reaction. Selling this Friday's Iron Condor, electing to sell the 175, 180 call vertical alongside the 155, 150 put vertical. If a trader or investor using this type of a strategy is able to collect a $1.75 credit on this particular trade illustration,
8% now.
it would mean that that would be their max profit, be $175, and their max loss would be $325. You find that by taking that $5 wide spread on either side and then subtracting out that credit, and you're left with $325. The break even, you just simply take that credit away
We're
from the
not
short
feeding her
strike
through
on
the
the put
barbecue
side,
play?
Below, and on the call side you
Strong
add it,
malnutrition.
you'll get to those break evens of 153.25 and 176.75. So you see that nearly $22, or I guess $22 or so break, or a window of break even here. It's actually $23.50 as I do some mental math. You have $23.50 window basically where this thing can be profitable, and you have a window of about $20 where you actually are at max.
This is just selling off because of the fires, right?
Max loss is capped out at
Got downgrade to
325.
junk.
That falls below 150, where these options are in the money on the put side, or above
A heck of a thing for you to do when their islands are on fire.
a strategy looking for kind of a boring earnings release here, Jenny, not hoping for fireworks.
They just downgrade
Right, not
upgrade
hoping
based
for
on
the
what the
same event
stock's
we
doing.
saw obviously back in May, but now to shift gears here and look
It goes
at
that way, and then they say, "Oh yeah, it's
I am
junk."
seeing we did get some news that they're pulling back related to the fact that Elliott
Oh, it's
Management
maybe
did
their
reveal they
their
dumped
power
their
companies that was the
stake
source
in
of the fires.
PayPal last
Oh
quarter.
jeez.
So this is something that's just come out
I
in the
see.
last 30 minutes. This
That's
makes
right,
more
Mel.
sense
You
why
were saying it was
seeing
from a
the shares
power
well
line.
off of their session highs here, Ben, because I was like, the CEO shakeup to me didn't make sense. Elliott Management took a stake in PayPal last summer. This is obviously not what you want to see in this string of bad news that's been following PayPal. So walk us through what you're seeing from a chart perspective.
Yeah, well, first and foremost, Jenny, again, it's had this 30-period simple moving average continuing to move to the downside. Bit of an intermediate term upward run, and
Yeah, I don't know if
actually
I'm gonna
I
mess
was
with
setting
that.
up for
I
the
think about
idea
that whole
that
part of it.
the RSI, again, diverging slightly bullishly, much
Could
like
be a
we
good
saw
short.
on Estee Lauder. It was sitting right at that oversold line, but I was also
crazy.
noticing that today's candle was kind of extending the gap down sell-off. We had a bit of a bullish candle, almost a bounce
Wow, those
yesterday.
options must have gone
It
crazy.
gaps down from yesterday's close
On the 11th,
and sells off, and it's
14th.
down near
Where were you guys
this
on that?
support right around that 59.5 mark.
We knew about the
Potential, though,
the
is
fires
there
last
still
week.
for a possible bounce. We're past earnings. If this news can be digested quickly, it could get a bounce back up to that resistance up around that 66 mark. But if we get a break of the 59.5, then you simply take that distance between the 66 resistance and the 59.5 support, flip it to the downside. That puts you right around the 53 mark as a possible support below. But still, now the RSI is going to lag a little bit. So if we get another candle closing at or below this support, it's likely we're going to see that RSI continue to turn around to the downside and suggest there might be a little bit more of a push lower. But this support level, 59.5, hasn't been broken yet. It's been tested once, twice, now potentially 3 times as a level of support here on PayPal, guys.
And we're hoping we don't reach below, basically $59, like you said, at the 52-week low here. So that would be pretty ugly for a stock that's already down over 15.5% on the year. But we will leave it there. Appreciate the technical breakdown, Ben Watson, our chart master. So now in trading this name here, Alex, I mean, given the overall weakness we've seen in PayPal, not just year to date, over the last 12 months, I mean, this name is down 40% over the last 12 months. Perhaps you're looking to see some optimism in PayPal and you think that the selling is overdone. You're leaning into a more neutral to bullish example trade. Walk us through your thinking.
Yeah, no doubt. Looking for that support level to hold, I think, Jenny, would be kind of the crux of this particular trade illustration. We're right at it. Obviously some weakness here today. Hoping that this is kind of the end of it if you're implementing this style strategy. What we're looking at doing is selling a put vertical below the market. It's a trade illustration that would be referred to as neutral to bullish. It's a premium selling strategy, but it is a risk-defined strategy. So in the event that that weakness did continue, it would be kind of a situation where you have a max loss and you know your risk going in while entering that particular order. What we looked at in particular here in PayPal is going out to the September monthly cycle and selling the 57.5, 55 put vertical. So it's a $2.50 wide spread. In that time cycle, it's actually the smallest, basically spread that you could do at $2.50 wide. And if we're able to collect the 50 cents on that $2.50 wide spread, that would be 20% of the width of the strikes, and it would create a 4-to-1 risk-reward ratio. So it's a strategy where you'd be risking $200 to make 50, but the break-even would be at 57. So it'd be about 5% below the current share price of $60.30. And you can see, looking at that risk profile, that it's a elongated Z risk profile in which we start in that max profitability zone. We have about a $3 cushion to that break even, and that break even, of course, at 57 is indicated by that white arrow there on the screen. Beyond
you know about
that,
EBIX, Kitty?
Down to 55, you would be at risk before
looks
it caps out
interesting.
at $200 per spread. And of course,
cut their
the max
dividend,
loss scenario would be if both these options were in the money, going to expiration. You faced assignment and auto exercise of those short and long puts, and they offset for the full amount of $2.50. You net out that 50-cent credit, you're left with a $200 loss. But
I think it has a wide range
scenario,
of
these
trades
options
in.
just expire worthless. That support holds, and we move on, keeping that 50-cent credit.
All right, I think that's really well put, and obviously a different way to look at PayPal, just given some of the overall pessimism that has been hanging over that name like a cloud. And I know even names like Block are lower, but not to the same extent that PayPal has been lower for the last 12 months. But also, as always important,
is that big sell-off just from earnings?
Today, they do contain multiple legs. That can lead to higher transaction fees. Short options can be
Must
assigned
be
at any
right.
time, and carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now coming up next, it's time for FOMO. We are looking at Target, another name that is nearing these very critical 52-week lows here ahead of its second quarter print expected tomorrow morning.
Oh no, we're talking about HE with Hawaii. The problem is the fires wiped out a big portion of their market for even energy, customers, real estate. And if they were the cause of the fire, You're gonna have all sorts of litigation. So I do want to do a bounce play on it. I might wait a little bit. Seems a little early. Yeah, I mean, there's like if they're proven that they're not, that's catalyst for a huge rip. Once you know, news slows down of people missing and deaths, that could also cause it to start to rally back up. Any other banks kind of helping them shore up liquidity, of course, would help it rally, because you might have a liquidity crunch. Because they're in the banking segment too, which is kind of weird. They do it all. Are these options new? Why is there no open interest on them? What? Oh, they just added these strikes. Their lowest strike was 17.5. Oh man, that's bad. Yeah, especially in Hawaii. It's not like there's competition. I'm assuming Maui runs on generators too, just like Oahu. But there's just a big portion of population that's not going to be needing electricity anymore. And they're in real estate too, so I don't know. I think the worst though is probably the catalyst of bunch of litigation towards them if they did start it, and if they're not able, of course, to provide enough liquidity on their banking side.
Results. Some analysts have weighed in on that. We'll have to see if they have a material impact. I typically don't like to get into the controversy surrounding these companies, but what I do know is their revenue is expected to fall 3.3% to around $25 billion. Second quarter profit per share is expected to be around $1.3 billion. We also hear from Walmart tomorrow morning.
That'd be pretty bad.
Thursday morning as well. I think this is going to be so
Very
interesting
likely.
because so often when
I don't
both of
know.
these names are blowing it out of the park, we compare them
It
to
seems
each
like the
other
main
because they're
power
both
company in
like
Hawaii.
the competitors to Amazon in a brick and mortar sense. But now I think the fact that Walmart is a grocer, I mean, it's the largest U.S. grocer in terms of its footprint. I think we'll see the way that that benefits a name like Walmart, because given that staple-esque nature, we can see in the performance this year that it's been able to
Definitely keep an eye on
outperform
it,
a name
though.
like Target sizably. It was just right around its all-time highs last week. A
They
completely
just added all
different
these strikes down to
narrative than what is
$2.50 on
surrounding
the
Target.
Septembers.
And I will say that I am the worst person to know what is like cool. My barometer for what is trendy among people our age is awful, but there is like a cult-like following to Target. It's all over TikTok where you could see people that find like Target finds, and it's a whole thing. But what I do know is right now with people pulling back, I mean, that sort of exuberance is definitely not one to last. And I have not been in a Target in quite some time. I do know that people love this brand, but I think our urban exposure is just not indicative of what the rest of the country is facing.
Yeah, so a lot to explore here and to unpack, but I'll do my best, Jenny, as I think you kind of hit the nail on the head with all the things that are sort of surrounding Target at the moment. You know, first off, none of these things are happening on their own. So you have sort of student loan repayments set to kick back in. You have a consumer that's pulling back a little bit in terms of spending and shifting away from goods towards things like services and travel. And maybe, quite frankly, just because a lot of those things were planned quite a bit in advance, not even necessarily because they were new things that were on their calendar, but rather, you know, you book a trip to Europe, you don't necessarily do that the week before you go. Oftentimes, those are things that you had planned for quite some time, maybe even paid for quite a bit ahead of time. And so that's one side. Obviously, that's not going to fit. That's not going to necessarily, be a great fit for a company like Target that targets a younger demographic on primarily discretionary items. At the same time, though, they have faced political backlash, and who's to say, you know, ultimately what that impact of calls for boycotts and some boycotting will be. But it's not necessarily happening at a time where Target is, firing on all cylinders. And this is why this stock has underperformed so greatly this year, with the stock being down double-digit on a percentage basis. Compared right now, it's down about 15.5% year to date, where you talked about a company like Walmart that is basically at all-time highs. So I think it's very difficult to compare these companies as they exist anyways. Their product mixes are a little bit different. Their target demographics are maybe a little bit different. But more so now than ever, you're talking about a company that is firing on all cylinders, and really the biggest knock on them in the case of Walmart is the fact that they're at all-time highs. In the case of Target, it's the perception of, yeah, this has been a brand that's done really well. It's struggling right now, but is now a good time to enter because it has been struggling. Those are two opposite questions.
I think timing the bottom in this name, at least in relatively speaking for this year, has been difficult because it's just been pretty much consistently trending to the downside. We are seeing shares down just over 7% now month to date, down about 3.5% this week into their report, down about 31% off of their 52-week high, and we're just a percent off 52-week lows at this point in this name. Well, majority of that selling did follow 2 earnings reports ago, when we saw shares just absolutely crumble, touching then $125 a share. But we're pretty much right back there. So I guess it depends, again, on your opinion on this name and your positioning, if you think that the selling at this point is priced in and some of this pessimism is priced in. I also will say that Target isn't cheap. That's primarily the reason I don't go there, because it's one of those places you walk in and you leave and you're like, what did I even buy? And so if you're trying to right now mitigate some of that spending, I do not go into a Target for my own personal financial reasons, because that place will get you. But I do know that the analysts covering this name split fairly down the middle, 18 buys, 19 holds. Not a lot of bears in Target, I will say, and the price target does imply it's around 160, like 27% upside from where
Price
we're
target,
trading. So
good one, Jenny.
analysts are holding on for long
AMC's
term
up
here. So walk us through what you're
9.3,
thinking as
still
far
filling
as
that
how
gap.
an example trade goes. Of course, this is
Premiums,
an
I don't think are
earnings
moving,
event,
though.
but it will be interesting to see if we could see
They're
things
so juiced already, they're just
recover a little bit, or just
everything's priced in.
continue to trend to the downside.
You know, real quick, if you go into a store and you have no idea why you're there, you shouldn't be in the store. You got to go into the store with purpose. You got to know what you're going to buy and only buy that, and you will never spend too much. That's my little pro tip on
Alex,
navigating
that would make
Target.
way too much sense.
The problem is then you go to Costco. you got a Costco and all wheels fall off the plan, and you can end up spending a lot of money. So let's get back on track here, though. Trade illustration time. I looked at a neutral to bullish strategy. It's omnidirectional here. It's risk defined. I think there's a good chance that Target, with all the factors going on at once, could have sort of a volatile type report. It could clearly it could miss to the downside if some of these political backlashes and spending pullbacks are worse than expected. And we might have overestimated the impact as well, and it could, quite easily have a strong quarter as well. But because there seems to be kind of a lot of variance in what could be reported, I think it sets up
coming down
a
here a little
situation
bit.
where there could be quite
We're going to retest the lows again.
volatile response to this particular earnings announcement. So I wanted to do a strategy. I went neutral to bullish just because I do think amongst the kind of millennial and Gen Z or Zoomer, I guess, generations, I think Target is very popular. Given that's sort of our brand for this show, I wanted to look at something that was kind of positive on Target for that reason, but you could use this same strategy in a neutral to bearish way using calls as well. We're looking at a skewed put butterfly to the downside, buying one of the 126
Barbecue
puts,
still down
selling
3
two of the
1/4.
123s, buying one of the 117s. Essentially,
BNT up
this
$7,
$3
liquors
wide
up
debit spread
6.
being purchased, and then a $6 wide credit spread being sold. Doing the whole
BBIG
package
down
for a 50-cent
37.
credit. These options are all out of the money, aka the stock stays where it is or moves higher.
HE.
The trader or investor deploying this strategy
Down
would hope to
20.
keep that 50-cent
See if it finds any
credit
support on
at
that 1639.
expiration. If it does go lower, the
Support
risk
from
profile
many
will do a
years
good
ago.
job illustrating kind
This
of
might
how
be a
this one
good
performs.
buy,
There's
honestly.
a sweet spot right at the short strikes
Long
where this
term.
thing can expand to as much as 350. That's where that $3 wide debit spread
31-cent
works in
dividend.
the favor of the investor, but then also
Yeah,
that
the yield
credit,
right now is
is
8%.
kept as well. Not the highest
buying
in
it at
probability
2014
events, Jenny,
prices.
but what I always think is most important about this strategy is what it does to the break even. If you were to just to sell a put vertical at the 123 mark as your short strike, you wouldn't get a break even for this amount of risk down at 119.5. So it really pushes that break even down lower to 119.5, which is a good amount below the current share price of nearly $7 lower than the current share price. And then it also reduces that overall risk. Even though it's a $6 wide spread, the total risk is only $250 because that $3 wide debit spread works in the favor of the investor if it is in the money.
And I think that's really well put. And obviously, we'll be keeping this name on our radar. They report alongside TJX, which very different company, but we are obviously very retail heavy as far as earnings go this week. But now coming up next, we will look at a name seen some more positive price activity this year than at least Target, although not today. Shares are down about 0.5%, but that is Brinker International, which is the parent company behind Maggiano's and Chili's and some serious suburban eating. So we'll be discussing that more with Kevin Green coming up next.
Ebix has or Hawaiian has X Divi on the 17th. I'll put that on here. Might not have much effect, but you might even get more of a sell-off after that. Little inverse head and shoulders there on the 5-minute on GNS, holding up really well, down 5%. GME's down 3. That's down 2.4. Jumia, oh man. Big miss on Jumia's earnings. Rumble's down almost 12. Oh, Rumble. Barbecue still down 3 1/4.
Baby back ribs over at Chili's because they are delicious. But from a technical standpoint, we are seeing the stock actually test the 200-day moving average. You do not want to see the stock break below that, and if we do, there could be a little bit of a gap to the downside here. So a lot of bulls in this marketplace, especially for the stock, need to really try to maintain it above that level. And we continue to see
nice and quiet today.
At around 40, let's say $40 to $41
after a huge rip like that,
where we could see a little bit of a triple.
I didn't realize that flight on space was the first one they've actually done.
You don't see that happening. So right now it's kind of like in this
sell-off, breaking the lows.
Especially when you're looking at the 200-day moving average, which is considered to be one of the more.
I thought there was another one before that we missed.
Really look at. So
this is definitely a sell the news.
Hopefully it can do that by being able to push up after the earnings announcement tomorrow. But if we do see
mixed with the market's
back to
kind
the
of
downside here, you're already seeing some of those
risk off right now.
Chart. That could be a significant gap. And unfortunately,
there's new lows on space though. That's
talk about a potential trade, but unfortunately, not a lot of options activity. Spreads are pretty wide. So if you're a long holder on the stock, it's kind of hard to be able to hedge the position too for downside risk without paying a significant amount of premium or trying to get a fill that's going to be somewhat favorable for the trader.
Yeah, Kevin, not a ton of volume in this name either, just given the fact that we do have this earnings catalyst tomorrow morning. So an interesting one. You had me at baby back ribs, though, so I was sold that. So we'll obviously be keeping this name
AMC,
on our radar.
AMC still going 10%.
Thank you, as always, Kevin Green,
10.5.
senior markets correspondent for the network.
Really have to
now,
just
coming
hold
up next,
the
it's time for
underlying,
Under
though.
30. We are looking at Ford.
Options aren't
On some
really moving.
analyst news, Morgan Stanley keeping its conviction on the name. Shares are down 1.5% today after several negative catalysts that have propelled shares lower over the last several weeks. We'll discuss that more with George Tillis coming up next.
GNS kind of breaking down there a little bit. Down 9.
The UAW issues with contract negotiations. I think at the end of the day, it's going to cost both these businesses quite a bit of money to keep their production facilities open, and I think that's what the market is essentially telling us. Because if you look at the last 30 days, both of these stocks are down about 20%.
Yeah, I'm even more nasally right now.
And if you compare them to, let's say, international automakers
AMC's
like
up
Honda, Toyota
11.8.
Motors, it seems to be more of a domestic production-based union contract issue versus a total vehicle sales issue. I think at the end of the day, also Ford is facing maybe some secular challenges because they're retooling their factories to catch up with the demands associated with electric vehicles. While at the same time, prices seem to be stable, if not falling, when it comes to the new vehicle
Base is down almost
sales.
7.
And I think that's, again, another challenge to potential margins for Ford. I'm not surprised to see the stock down as much as it has been in the last month or so, considering, again, these UAW contract negotiations can be quite cumbersome to both these companies, particularly if the concessions are made to appease the workers. That's just going to get into profitability for the businesses. And I think the price wars that are going on, at least in the EV space, have also created a situation where perhaps growth in margins might be constrained because of the fact that, again, there's a lot of competition out there, especially in the EV front, but also, again, in the total new vehicle production front.
All-time lows
George,
on
I'm
the
not sure if you
space.
saw it, but I guess one of the headlines I was referring to is this tapping of the former Apple executive Peter Stern to head up a consumer experience, segment, strategy for the company. I'm going to read something here from this Wall Street Journal report basically about this, that basically this unit's going to oversee out-of-vehicle customer experiences, and the example that they provide is using a car's camera to recognize a bear while the driver is asleep when camping. How is this going to sell more cars, George? If I'm an investor in Ford, this upsets me.
Well, I agree with you, Alex. Look, so what's going on here, and by the way, I will say this, in my experience also, changing of the guard when it comes down to the executives or adding or changing the head of a business division can make a meaningful move in the short term. In the long run, I don't necessarily think it's a game changer. I think what's happening here in the automaking space or automobile space is we've talked about this, where there used to be so much volume. Companies were making money on lower price, higher volumes. Now it's high price, low volume sales, particularly when you have to order specialty vehicles or low supply based vehicles. Another way to make money is, of course, recurring revenue, subscription services. In other words, paying for features that your car already has, so like heated seats, heated steering wheel, so forth, and all the other ancillary features and services that you just mentioned as well. Is that a good business strategy? You have to ask. One would say perhaps it is, but perhaps it's not, if that's the case, going across multiple automakers, not just Ford.
Yeah, and I think that's also a really important point here, George, and just considering the fact that we're finally starting to see some of these auto sales cool. I mean, that also isn't exactly what you want to see when you're a name that is falling consistently, now only up about 3.5% on the year. But we will leave it there. Appreciate the breakdown on all things Ford and the general auto space right now, which has been hit with some turbulence. It's George Tilla, Senior Markets Correspondent for the network. That also does it for Alex and myself for Next Gen Investing for this Tuesday.
KBNT at the highs, up 9.3. It is neat. What do you mean day right after that launch? The launch was good. Everything went good. This is a sell the news thing. For some reason, was it the first one that failed? 'Cause I thought there was another one that happened before this. But maybe it was just a private. It wasn't wasn't to the public yet. eBet's ripping 17% on that thing. Ugly chart. Chain engineers? I don't think there's any, yeah, maybe. I'm not sure. I'm not seeing any news on the sell-off. This is just continuation from their earnings, which wasn't all that bad, I guess. But I think it's just an excuse to get out of it. And then the launch, which, it's all in the news. The event's over. Let's sell the stock. Don't worry, guys. I got something for my throat and my sinuses. Make it better. Nice glass of iced coffee with cream. Delicious cookies and cream. That cream got 10.5% on AMC. And the options have gone nowhere. Oh yeah, HE has ex-dividend date. Forgot. Yes, little bounce there again.
Some of our biggest banks. This is pressuring our entire market here.
About Hawaii?
We've been talking about, Nicole, this is where we're at. This is a global situation. China, deflationary real estate bubble collapsing potentially that could really impact their situation economically, and then how are we going to continue to get what we need from them? So there's a big concern about China.
Thanks for
it's
covering
a
the commissions today.
As much as they're wanting to topple America and take control of the
China's real estate's been collapsing for like
country, they
5
still
years.
We are still in a symbiotic relationship. So as
Remember
they
seeing
go,
those towers fall.
It does affect us. It does impact us. But
all those empty apartment buildings.
Me at all that Fitch is giving these warnings about the
It's
U.S.
literally
banks.
collapsing.
I have been saying
Honey
the
and hot
banking
tea.
crisis is not over.
Try
we have
again,
a
Jay.
liquidity crisis. We have an M2 money supply contraction through July that is recession depression levels. 4.8% year over year contraction tells us that there is a liquidity problem. When you have quantitative tightening on top of that to the tune of $100 billion a month, the Fed has to do something. They have to help. This is a stimulus-based economy, and when the stimulus stops, the world stops.
Right, understood. There's so much to sort of break down here, but I know you have your eyes on a meeting in South Africa. Tell us a little bit about that.
So this is the annual BRICS Summit, BRICS, Brazil, Russia, India, China, South Africa. We have over 45 nations that will be in attendance. And
open up a position in the Theta Farm.
Have made formal applications.
Red days
We're
like
really
this.
looking specifically, we don't see us
Good
in formal application from
opportunities.
Saudi Arabia, but we know Saudi Arabia has already joined
Long as they don't start to have
Shanghai
capitulation.
Corporation, so it's not like they're sitting on the sidelines just.
I think you'll be riding them
to
for a
the
while,
west. They
but
are
that's why you pick stuff you're happy to
towards
hold.
the BRICS bloc, and the UAE, which is a
Send it out
huge
to Theta Farm members on
important
YouTube.
group, and OPEC is also moving towards the BRICS bloc. So this is just a really trying time, Nicole. This meeting that they're having in Johannesburg on the 22nd through the 24th is them saying, how can we we bilaterally exchange amongst our members. So if you have 40-something members of BRICS eventually, when we get to that, you're talking about the GDP of nearly half of the world potentially having conversations moving outside trade of the US dollar. So this is the end of dollar hegemony. Yeah, Nicole, go ahead.
Yeah.
Sorry.
And look, I mean, I couldn't, I'm so happy you brought this up, because when you talk about the BRICS, group, right? Russia, India, China, I mean, right off the bat that they have their own collaboration that happens, and Russia and China are not necessarily our best friends these days.
Right.
I mean, they practice together without us. So it is worrisome. And, I like to think of the U.S. dollar as the world's reserve currency, and that's another topic that people are always concerned about. It certainly seems like it's staying that way, but it is a concern. Tell me what you're telling clients to do right now. You have a market that goes back and forth. You have the VIX creeping higher. We're down 2 of 3 days in the S&P, but it's a winning year. What do you tell?
Well, I don't think that the fundamentals, Nicole, it comes down to fundamentals. Always go to the fundamentals. The fundamentals can be manipulated and they can be fooled for a while, right? With the stimulus from 2020, we could get through the system and deal with that for a while. But now with the Federal Reserve in a negative interest rate situation on a monthly basis, and with interest rates so high, and with liquidity drying up and quantitative tightening and the M2 money supply coming down and lending lending has gotten so tight. So now you've got corporations that are not going to be able to refinance when they have to. And this is where you start to see the beginning of a recession or depression. And I hate to say that, Nicole, but we have to call a spade a spade. This is the reality that we're dealing with, and we have to go back to the fundamentals. So I don't expect us to end the year to the positive as much as NASDAQ has done well, as much as S&P has done well. I do expect disruption for the rest of this year, and we're starting to see it now. We've already started to see the labor numbers turn softer. And so all around, we have got on all fronts, Nicole, major challenges. So I tell people to prepare for potentially disruption, big disruption ahead. And until we see the fundamentals showing again that we have liquidity in the system, that banks are lending, that people are optimistic, and it's not just all, this pipe dream of everything's going to be fine because it's the US dollar and it's America, then we can't go back to kind of a normalized situation where we're really ready for bracing for problems.
When do you think it's time to get in on the financials, if at any time? I mean, I had a guest today who said he liked financials, he liked industrials, but financials and healthcare. And I asked him, and he said he likes the big money center banks.
Sending
another at the same time,
further message out to the State of Farm on YouTube.
Time,
First roll I've done in the last 3 months since I started this farming account.
Putting some of our banks on watch.
3 months, 4 months.
Would you ever go
So that's
into
pretty
the
good.
financial sector and say
I've been able to close everything up for profit.
Absolutely, but not right now. Not while we're in the
50
middle
to
of the transition
75%.
period.
Sometimes 20 or 30%. There's other factors, but almost always
about yet, but that
50
is
or
the
more.
precursor to digital dollars, the platform for it. I like the financials. You can see JP Morgan did really well when they acquired, SVB. We can see that, the bigger banks are acquiring some of the regional banks. That can make a quarter look really good until you start to realize, well, what was the problem with the bank? And now we have to deal with the actual problems of that acquisition and working through that. So because we're in a period of disruption, especially financial disruption, currency disruption, the financials are not my place right now to go. I know that central bank digital currency is going to upend banking, so we have to think about that long term as well, Nicole.
What about the Magnificent Seven?
Well, what can I say? I don't know. I think that we just have to brace and wait till this all plays out. And people just need to understand this is not a normal market, Nicole. We just have to be prepared. This is unusual things happening. And people want to say this is normal and it happens all the time and the market comes back. This is not normal. These are not normal circumstances globally.
Yeah. How about in a year from now? Do you think that the
Free tacos at Taco Bell?
even maybe that the Fed
For this Tuesday? Is that real?
I think that we're talking about dollar
Being up
hegemonic
to
disruption.
Uber Eats, Chipotle,
and so
double
the Fed
protein
is going to
burrito.
have
This
a
is the
lot
way.
of work to do. I just see that I do think a year from now we're going to be in a much different place, and I think it's going to be a better place, but it's going to come after a lot of pain that people are not prepared or expecting. I hate to be such the doomsayer, but I just read the numbers. Like, I'm a numbers person. I'm a data person, Nicole. If the data says this is where it's going, I have to follow the data. And we have just all fronts that are just on the negative side. We don't have a lot of positive winners that are bringing us up. Even the labor market is now turning, which was the one stalwart that Powell's been relying on to do these 11 hikes, since he started on the hiking mission. So everything is saying be cautious, take precautions. But next year, I think we'll be in a much different place after the pain.
Right, understood. And when you think about investing in fixed income, I mean, obviously you're seeing rates on the rise, or they've been higher. And look, even the 10-year, I mean, we're seeing it, 4.2 today. It tells us something, right? Somewhere to put our money.
Well, it's the inverted yield curve. This yield curve has been inverted almost as, that's a tell right there. So yeah, long-term money paying less than short-term is a problem for sure. Yeah. But the 10 is coming up, so that's good.
Right. And look, if you have money markets and all that, you can make some money. But to your point, that inverted yield curve, and in a big way, not just an inverted yield curve, but a hugely inverted
and that's
yield
why the banks are getting that's why the banks are downgraded, Nicole. Right. That's why they're potentially getting downgraded, because they borrow on the short term for these loans, and they lend on a long term. So you can't lock in long term lower rates that you're earning when you're paying out higher rates on the short term. It's a problem. It's a big problem for the banks, and that's the banking risk right now.
Yeah, it's like the 70s. We're back to the early 70s.
It is.
Rebecca Walser, thank you. Walser Wealth Management.
You,
thanks so much for being
What
here.
my rip spy.
All right, later this hour, we'll go one-on-one with Beam Global's CEO, Green Energy, and record revenue. Also, we will welcome the CEO of GigaCloud. The company just posted record profits and have an eye on mergers and acquisitions as well. Let's ask about that. Our panel will check in on the pulse of the consumer after the July retail sales report and ahead of the big box store earnings that we want to hear more about. And up next, Kevin Horner is here. Technical Tuesday. I really want to see what he says, just even about the S&P 500. But he's also watching Lowe's and Cognizant Technologies.
Taco Tuesday. That's awesome. This is gonna be bumping. No purchase necessary. Valid on Tuesday, every Tuesday this month, and then first Tuesday of next month. One per person. That's not even worth the drive there. My Uber Eats the free taco. Paid $10 for the delivery. If I was gonna do some fast food and I was already out, that might persuade me. No other way though. Well, Doritos taco? Oh, slightly better than a normal taco.
gains put it on pace for its best gains in 6 years. Back in June, the company rejected an unsolicited bid that was valued at $5.76 a share. Lumber liquidators. Everybody remembers this if you've been on Wall Street for a long time. Okay, Lyft shares. Well, those are getting a bump. CEO John David Richards disclosing that he purchased 100,000 shares on August 11th from 1.1 million. He now owns about 12.4 million shares of the rideshare company. Lyft shares are up about 55% since falling to a 52-week low at the end of May. On Holding is on pace for its biggest one-day percentage loss since May of 2022 after its adjusted earnings decline. But in a note,
all right, Spy's gonna make his trek up.
A buying opportunity, pointing to
up to the top of this cup.
Estimates on Holding shares
4 hops.
are more than 70% year to date. And shares of Kava are continuing a downward trend ahead of the first earnings report of the call since its IPO in June. Zacks is expecting an adjusted loss of 3 cents a share. So far, Kava shares have fallen more than 18% since hitting a high water mark of 58.10 on August 2nd. And check out Bitcoin.
GNS little pop there up to VWAP.
29,365. It's just been hovering around this area for some time. Okay. Now it's time for Technical Tuesday. For that, we welcome in Kevin Horner, Senior Manager, Trader Services Education at Charles Schwab. Thank you for being with us every week for this special Tuesday event. How about what's going on with the S&P 500 today? I mean, we talked about Discover, which is the big laggard. But, you know, look, in the morning we were saying 2 up days in 3, but now we're saying, you know, that we are under pressure. This is the S&P's second down day in 3.
Didn't get the follow through many traders were looking for yesterday. That excellent move yesterday, big, beautiful green candle on most charts, and you finished at the high, taking out the high from Friday, and you would have thought, yeah, we got a little opportunity for continuation. And unfortunately, it's just a reminder that news has a lot to do with our ability to continue our trends. And so what I think a lot of traders are monitoring now are the lows from today, coincident with the lows from Friday, both of which reside right at the 50-day moving average, the level right around 44.40 on the SPX. It's an important level because it does consist of a higher low even still. We see that dashed green line below. That's the 50-day moving average there. And so we have comfort here, Nicole, but if we slip through it and we make a move down to the next level, that could be somewhere in the neighborhood of about 43.85, maybe a 50 to 60 point move. And that would be looking at the lows that we saw in early July there, July 6, 7, and 10th, where we kind of tested that 4,400 down to 43.80 area. And that looks like another level of strong support if the 50-day doesn't maintain. So I think traders have to be on their toes here. Obviously, we have a belief that we could maintain the 50-day, but slippage on a close through the 50-day could easily bring us to that 43.85 level. So a pretty important ledge here. Can we get it back in gear? We're just waiting to trade one way or another above the downtrend line that's been in place since the peak or below the support we've set now the last 3 sessions here.
All right, 43.85. Wrote it down, Kevin. I mean, I definitely...
Hoping not to see it.
We're at an... Yeah, exactly. Right, the good point, because that's exactly what we don't want to say. Do you remember lumber liquidators? Do you remember that whole story with the formaldehyde and the flooring? I can't believe it. I can't believe it pops back up now on our movers of the day. I can't wait to see what happens with this company. In the meantime, you and another company you're talking about, and thank you for remembering, Cognizant Technology Solutions. So why is this one jumping out at you today?
Well, largely because what we have is after a break higher on good earnings back here in the beginning of the month, we had this wonderful gap move. And since the gap, what you've seen is lower highs and higher lows, creating a pennant formation. And the pennant is traditionally a continuation pattern. So when you get a breakout and then you consolidate over 2-3 weeks, as we have done here, what you're seeing today is testing the lower end of that consolidation, that trend line that's been working. And so we're in danger of breaking this to the downside, and yet there's still really solid support beneath at around 68.5, which is basically the low of the gap move on
AMC.
earnings. And so the chart looks a little messy
They
because
had,
there's been a lot of great action, but I think
the conversion is approved, so AMC and APE are going to converge.
Provides traders
AMC is going to have a
opportunity
reverse
because
split,
you frequently will get a breakout that
and
comes back and
probably
tests the breakout level.
lots of
In this
dilution.
case, the breakout level is right around 68.5. We have
The
been
gap down was from
through
the
it
approval
on earnings
on the
previously,
conversion from
but
AMC to APE.
the last two times we were in this area on earnings, they were levels at which we got rejected and traded lower. This last earnings was one that brought us into that area on a positive review. And so I'm kind of looking at this saying I'd love it if the triangle or the pennant would break to the upside. That would be over 71. Today's action really leads to me to think that short-term traders are watching that 68.5. So downside, hopefully hold 68.5 for the bulls. But even still, Nicole, that long run trend line that's drawn in from the bottom, that goes all the way back to November. And that it tells us that we've been in an uptrend since November. So maybe traders on the long side would only lighten up position size if things broke down a little bit below that 68.5, maybe came back to the 50-day moving average or the trend line. But it's just a matter of holding what you're comfortable holding for a potential move that could bring you back maybe as low as 65 or 66. You just got to be able to weather those storms when they hit.
Back up to VWAP.
The only way I have found to do that is by making sure that the position I'm
RAD
sitting
down
on,
3.4.
I can handle getting down to that ultimate level of support. And of course, if that ultimately breaks, then traders need to be comfortable moving on from there.
Understood. Thank you so much for that. And then there's Lowe's. This is another stock you're watching after its earnings. So tell me a little bit about that one.
Well, this one was.
Hold on. We had the earnings from
We
Home
have
Depot,
them coming up.
right? And we're waiting on
Right.
those.
We had Home Depot this morning, and we have Lowe's coming soon again. But the interesting thing I thought was how the pattern as it applied to Home Depot was showing a lot of short-term resistance at the peaks we have seen since the summer and fall and of last year and the spring of this year. Now with Lowe's, we've already moved through those. So the green line there is support for a lot of traders. And the fact that we broke it, went to the upside, we rallied from basically late June to the peak here in late July. So we had a 1 month rally to new short-term highs. And then what have we done? We've sold that down, same level, right back to support and the 50-day moving average. And in the last week, what's really interesting, Nicole, is we came off of that 50-day, off that support line around 219, 220, and have pushed ourselves right back up above the 50-day moving average. Now, yes, today's candle is a little uninspiring, being that we opened higher and have faded into the session here, sitting on the 50-day moving average. But I think a lot of traders would probably continue to eye the 220 area as the ultimate short-run support here. We don't have a real clear indication you're going to maintain the 50-day, so you got to be willing to sustain that 5 to 6 point downside. But again, from the trend standpoint, having taken out the midpoint here, that green line already, and used it as support, obviously, if you're a bullish trader, you need to see that same level maintained. Under 219, this chart changes quite a bit, and I could understand needing to lighten up then. But in the interim, as long as 219 maintains its support here, Nicole, I think bulls have plenty of reason to stick with a position here.
Understand. All right. Thank you for all of that. A good look at a couple of good names in the S&P 500 today. Kevin Horner, Technical Tuesday. Charles Schwab, thank you.
Thanks, Nicole.
Coming up next, we'll speak one-on-one with Beam Global's CEO about the company's record first half and how it plans to expand green technology. Coming up.
Beam. Oh yeah, is it court today? That was me, sorry guys. Yeah, can you send me a link? You have it? Yeah, I was taking some screenshots. I emailed guess it's Kirkland and Ellis. Or no, it's Kroll's. What is it? Yeah, Kroll Restructuring. Emailed them about the voting and opting out. Trying to get my e-ballot. And you don't have to. They gave me some instruction, and then I asked them if I am not giving up my rights for litigation if I opt out. They just referenced where in the filing, but I pasted it on Discord under Happy DD. So this was their response. Please refer to the attached document, specifically section Article XD of the plan provides for a third-party release. We have also provided a link to the case website for your reference and to access additional information here if you have any further questions. I can link that too. I don't know if any of you guys had any question. I did. There was still some question for me on what I was opting out of exactly. Here's the link that she gave. Hey, Dink. Is there a court hearing today that I should put on? Oh, I guess it's rescheduled for August 16th. Jay from the Bay trying to get Tweet Shift to work again. I don't know if there's any way it's gonna work again without, I guess, a paid subscription, since you can only see so many tweets without paying. Thanks, Dink.
require a source of electricity and a mounting asset. We provide that more efficiently, faster, and less expensively than the traditional ways of digging trenches and pouring concrete, pulling wires. So I think we're very well positioned where that's concerned. And again, that's no accident. From a competition point of view, as I said to a banker the other day, I'm not afraid of competition. If I'm afraid of anything, it's lack of competition. This is a massive undertaking. We're going to have to build a fueling infrastructure in the United States for 300 million vehicles and globally for 2 billion vehicles in the next couple of decades. Everybody's going to have to pull hard on the oars to get this done. And in our wildest dreams, we'll never scratch the tip of the iceberg from a demand point of view. So competition's good. We're going to need everybody's clever ideas and innovation to move the thing forward. We're just really good at the part of it that we address, and that's going to be a huge part because, as I said, we deploy rapidly. But also, to your point about lack of electricity, we're adding capacity to the system without any need to build power stations, transmission, distribution lines. We do it rapidly, and we do it without risk from blackouts or brownouts, which of course come along with centralized infrastructure.
And I love hearing some of the stories, the background of this company too. But I mean, just so people know, you also have all-cell custom batteries, as well as the ARC Mobility trailer. We've been talking about that a little bit. Made in America certification. And some of the other customers, U.S. Department of Veteran Affairs, you know, you talked about the Army and the Marine Corps. And U.S. Department of Transportation. I just love this U.S. story a lot. You know, congratulations to you for having the foresight to hire many of our veterans who are so fully capable and show that discipline for success. I love it. Final thoughts. I know you're going to be expanding globally. We talked about Europe a little bit in our meeting. I mean, you can mention that. But I mean, where does this come from? I love this.
Well, you're right. For a long time, it's been very important to us. And again, you'll gather that I'm an immigrant. I love this country. The United States has been good to me, and I hope I'm being good back to it. But it's for a long time been very important to us to demonstrate that we can manufacture an innovative, forward-thinking product in this country better than offshoring it or nearshoring it, as it might be tempting for others. We've been doing that for over a decade now. You're right, we're going to expand to Europe. We're going to export this American-invented technology. We're going to manufacture over there. We're going to be increasing our profits and diversity of revenues in Europe, which is frankly the largest market for this type of infrastructure in the world. So that's going to be very good also for this American company. The European arm of our company will be Beam Europe, but it's all going to belong to us. We're a NASDAQ-traded company, and it's very important to us to do that. Where does it go? I mean, the growth is limitless at the minute. For the next several years, I don't think we'll see any end to it. We were for a long time a demand-constrained company. We're now supply-constrained. We're selling everything as fast as we can make it, and our team is doing a fantastic job of increasing their output. Same size team, more or less, same building, same factories, and yet 6 times more product going out than this time last year. I take my hat off to them. I'm very proud of them.
I'm glad to speak with you, wishing you continued success, and thanks so much for being on with us today, Desmond. It was a great conversation and a great story, too. Just
my great pleasure.
At the right time. Desmond Wheatley, CEO, Beam Global. Thank you. Still ahead in the second half of our show, we'll welcome in the founder and CEO of GigaCloud to talk about the company's record quarter and how it's poised for growth. As we head to break, take a look at winners and losers in the S&P.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. It's a day where we've been under pressure throughout the entire day. I mean, you could start with the China data, some concerns about the banks, as Fitch is looking at those and keeping a watch on some of the banks. Also, a stronger than expected retail sales brings back the soft landing story. Maybe some people are interpreting that as maybe a negative. Here's a look, because we're down 289 points on the Dow, down 39 points on the S&P, and NASDAQ's down 0.75%, and the Russell down 1 full percentage point. Let's turn our attention and focus now on e-commerce. Larry Wu, founder and CEO of GigaCloud, is with us, your company ticker GCT, focusing on end-to-end B2B e-commerce for large parcel merchandise. Tell us a little bit more about this. Give us an example of what the company does.
Hi, Nicole. Thank you for having me on this show. For those who don't know our company, we basically provide a marketplace. We're a pioneer in global B2B B2B e-commerce solution, helping supplier and retailer to transact their merchandise on our marketplace more efficiently.
And so at this point now, how's the environment? Because I know that you reported your second straight quarter of record profit. What's driving that success, and can it continue?
I think we are driving this success because of our unique product offering that can improve the efficiency of our supply chain despite the slowing down of the consumer spending. We definitely see some headwind as the consumer are right now spending less money on the durable goods, but because of the value we're providing to our customer, helping them to do business more efficiently, we're still growing by helping them to improve the efficiency of the whole supply chain.
What's it been like to be a publicly traded company? It's about a year since the IPO. Your thoughts on the current environment now, because you did mention some headwinds, but as you noted, some record profits. The stock has been year to date, it is up 73%. How would you say the current environment is?
I think we were a new company, as listed, it's only 1 year. So we were still trying to, introduce ourselves to more people in the investor community. So our focus is still, focusing on the fundamental, how we can deliver more value to our customer and how we can continuously deliver, more satisfactory financial result. I think as the time goes on, I think all those efforts will be reflected on to our stock price.
And at this point now, there's been a lot of talk about mergers and acquisitions, and your balance sheet leaves some room to be able to do that. Are you looking, or do you have something in mind? I mean, do you think you might even make some sort of deal between now and the end of the year, maybe?
Yeah. I really appreciate you notice that we got a very strong balance sheet. We got a very strong cash position. We were bringing in $18 million cash from operation last quarter. So we're definitely looking for potential opportunity that can bring us to more, customer, more channels, or technology will help us to do so, because of the market we're serving is very, very fragmented. So M&A definitely a approach that makes sense to grow our market share, especially when do have the resources to do so.
I mean, obviously you have organic growth, which we were just talking about, but growth through acquisition. You talked about technology and some of the business strategy and trying to advance the supply chain and make this happen. What kind of company would you want?
It's coming back up for VWAP.
And where would
maybe
it be?
to finish this cup.
For you?
I think
pretty epic
probably
bounce
the
in the day.
technology that connect us with the more
I'm out of trade,
suppliers,
so
or
can't trade it.
retailers, or
But-
anyone's providing technology that can help their customer to do
Mental
retail
trade.
more efficiently will be ideal for us to further integrate our technology with someone that's already serving their customer that could be our potential users of our marketplace.
Yeah, I think of a lot of these fintech type companies that are available at point of sale. In the meantime, when we look at the big picture of what's going on in China, and we've just talked to a last company, a CEO who's spreading out and growing in Europe, where do you see your growth plan?
U.S. is still our largest market, but we see very strong momentum in Europe as well. So our growth in Europe also contributed to the growth that we're seeing today, which is pretty robust. And last quarter, our GMV grew more than 30%, especially the third-party seller. They grew 65% year over year.
Fidelity, I think I've had the most issues with.
Do you think the environment will be better next year once the Fed's really, really done hiking rates as people expect?
Yeah, that's a lot of people's hope, including me. I think we, especially for us, I believe we already navigated through the most challenging environment, and we're looking for a better environment next year.
And just as I wrap up here and I think about the sellers and buyers, and I really wish you luck, and I hope you can get that footprint more in that space, those kinds of suppliers, retail type of space. Sooner than later, I hope you'll come on and give us some updates when you get ready to do that. I would love to speak with you again, Larry. Make sure you come right here and tell us more about it. Larry Wu.
Okay, thank you. Thank you for this opportunity.
Larry Wu, founder and CEO of GigaCloud. Still ahead, we'll bring in our panel to discuss the July retail numbers and how events such as Amazon's Prime Day, that's a continued push for
ETOO test the highs there.
That as well, that's continued to drive some of the spending habits we've seen. Coming up.
Jeez. Yep, down detector. Reporting outages on Fidelity. Still climbing. ETOO, new high on the day, 52%. Wine Electric, new low. I wonder if the dividend's going to affect it at all. Really like the price it's at. With the 50. Ringo.
Big promotional environment in July.
And that's not necessarily always so great because that means they're selling things at a discount. You know, it's sort of, you know, are they getting rid of too much inventory? Sometimes I'm not exactly 100% how to, you know, are you just trying to woo customers or is there some underlying problem? I want to
GME's
talk
gonna
more about
flush
this.
through
Ted,
that
tell me about
18,
what you
I
thought.
bet.
I mean, we did see promotions on
Like
Amazon's
that 18
Prime
maybe
Day,
in one
for
day.
example, and that always seems to do well.
Might get a bounce before then
Yes,
though.
I think Prime Day is a big part of these results. The fact that non-store
Bounce up to this
retailers were up
resistance.
about 10% year over year in July. Amazon led the way there. I think it's interesting that they grabbed some additional market share from the competition because department store sales didn't do so well. They were down about 3% year over year. So even though legacy competitors like Walmart and Target had their competing sales, it feels like Amazon did well. It felt like
Fidelity.
online was a big story. The only other category to notch a double-digit year-over-year gain were bars and restaurants. And I think the continued strength there is impressive. I think that's all about pent-up demand after the pandemic. It's been a second straight summer of revenge travel and revenge dining, and the consumer continues to spend in those experiential categories.
Saw that. I mean, just month over month, sales at restaurants and bars rose a robust 1.4% in July from June. And other areas in non-durable items such as clothing, sporting goods. Claire, that means people feel like, I know we have a very specific consumer. They're very selective on what they want to spend on. But hey, they're buying stuff, right, Claire?
Absolutely.
What are they spending on?
Remember that July is a massive back-to-school shopping month, and we know that parents took advantage of Prime Day and some of those other sales, and that's also driving some of those more essential expenses, getting kids ready for back-to-school, which shockingly has already started.
Yeah, I mean, they're even talking about Taylor Swift and Beyonce and Barbie. I mean, I almost don't even want all these things mixing into my Barron's read. You know what I mean? It's just crazy, but this is what's going on. And I do like to see that people are happy and feeling that they have the power of jobs to spend. Ted?
I think that's a big story. Like, even though we saw credit card debt hit a record high last week, the New York Fed reported $1 trillion in credit card balances.
Yes.
People are still spending, though. I mean, that's actually part of what's driving the trend, but people are keeping up. Delinquencies are still pretty low. The debt-to-income ratio is pretty low. You mentioned the strong job market. We're seeing a lot of the spending shift over to experiences, even more so than physical goods. But I feel like physical goods are kind of holding their own. I mean, yes, we've seen some declines in the bigger ticket items. Overall, though, I think this retail sales report is strong. One might even say too strong in the sense that I think some of the market reaction has been, does this incentivize the Fed maybe to raise rates a little higher or keep rates higher for longer? I think it shows that all these rate hikes have not done a whole lot to dent consumer spending.
Yeah. You know, were you surprised to see, for example, Claire, Home Depot's earnings beat the estimates? They unveiled a $15 billion share buyback. You know,
Home
housing
Depot doing
market
share
somewhat
buybacks?
sort of stabilized. I mean, I guess it's not going
Wow.
crazy. I mean, they're at new highs, but not like what we saw at the same trajectory at which we saw it. I think that's what I'm trying to say. So, you know, are you surprised to see that? And we're going to have some more names throughout this week, including Target, right?
Absolutely. So I'm certainly looking forward to seeing more of the quarterly reports come out, because I do think that helps us get a stronger read on the consumer overall. Great to see, you know, individual brands doing well, but looking forward to the larger story that we'll get when we can compare across a few of those key brands.
Yeah, I mean, Ted, are you worried that people are using their credit cards and digging into their savings as we await to hear from some of these other retailers? I know a name like Target, for example, actually had some issues, right? But we'll hear from TJ Maxx, Ross Stores, Tapestry, Walmart, Estee Lauder. It's going to be a busy week, but people are digging into their savings, Ted.
That excess savings that we talked about during the pandemic is mostly gone at this point, especially among lower and middle income households. That said, I think the spending trends are still quite positive. I would note that more than half of credit card holders are still paying their bills in full every month. So that's definitely what we want to see from a debt avoidance standpoint. It does leave 47% who are carrying debt from month to month, and that is up about 8 percentage points over the past 2 years. I think the big picture is pretty positive in the sense that it's still a risk-on lending environment. Credit card originations were at a record in the first 4 months of this year, but we're starting to see some pockets of pullbacks, especially people with lower incomes, lower credit scores, young adults. These are some of the pockets of trouble in the credit card world, even if the big picture is still one of pretty low delinquencies and low debt relative to income.
Yeah, it's great to see you both. I had a great panel on some of the retailers yesterday, and the feeling was Target versus TJ Maxx, the parent, TJX, parent of TJ Maxx, that TJ Maxx would be the good news story there out of the two of those, and that Walmart, it seems every analyst is hot on Walmart, particularly for the grocery. So we'll have to wait and get that. Claire Tassin, Ted Rossman, thank you both very much. Good to see you. I'm Nicole Petalides. Thanks for joining me on the watch list. I'll see you tomorrow at 11. Keep it right here. Oliver Rennick, Market on Close, next.
Buys coming down here. Get some calls for tomorrow since I'm out of day trades. Hold through till the morning. Hey, Kyle. Let's see, is it filed Chapter 11 yet? Well, it's trading on OTC because it didn't meet the requirements of NASDAQ. It's not in bankruptcy yet, though. Even once it's in bankruptcy, it doesn't mean it's going to trade at zero. You know, look at BBYQ. It's in bankruptcy right now and it's trading at 22 cents. Market cap of 163 million. BBIG is still trading. It's just trading on a different exchange. Market cap's only 1.43 million though. It won't just go to zero, it will just cease to exist. It'll be delisted, suspended, however it's referred to as. Not like a video game where you just ran out of credits. It's like you're playing and then the power just gets shut off. And you're mid-game, you already put your quarters in. 5 extra lives. Yeah, like playing Space Invaders. I was trying to say how it's not like a video game, but then I gave a nice, awesome video game analogy, so hope you appreciate that. Hour.
Caroline, I think it's all of the above causing some weakness here in these markets.
So, Kev, sticking with housing for just a second,
yeah.
Mortgage rates may be over 7%. Home builder sentiment may be lower, dipping to 56 points in August. But Warren Buffett decided Q2 was the time to invest in D.R. Horton, in NVR, in Lennar. What do you make of the timing of that investment?
Well, I think if you're Warren Buffett and you see bare minimum, we're in the late stages of interest rate hikes, right? I mean, we're closer to the end. No one knows where the exact end will be, but we are closer to the end than we are to the beginning or the middle. So I think Warren Buffett is making a fair bet. And Caroline, if you look at some of these home builders, their PEs are low. They historically trade at a very low PE. And they have pretty good, healthy balance sheets. So I get it. From a valuation standpoint, some of these stocks trade at pretty low valuations to the amount of money that they make. So, yeah, I get where Warren Buffett is making a stake. Like I said at the beginning of this segment, the U.S. is millions of homes in terms of supply than where we need to be, and we've lagged that since the financial crisis in 2007, 8, and 9. So yeah, housing is a sector of the U.S. economy that's going to remain strong for years, and the multiples in some of these home builders are inexpensive, Caroline.
Kev, despite rising interest rates and despite this inflationary environment where we've had to really face higher prices in just about every aspect of life, the consumer continues to spend. As you said, retail sales showed a pretty resilient consumer. The ultimate test will be this week, really, with an influx of retail earnings. But how would you characterize the consumer right now?
Well, the consumer seems to be. Now, there's metrics out there and there's data out there. They're starting to dip into their credit cards. The balances are going higher. But in my career, the one thing you can always count on, Caroline, good markets, bad markets,
maybe they're test down at the lows first.
The U.S. consumer and their ability to consume goods and services.
But it does end up being kind of a choppy day like yesterday.
It goes
or
from
a move and
moderate
then
spending in a weak economy to off-the-chart spending. And travel is still a big part of what's going on right now in the U.S. economy. I just got done traveling, and everywhere I went, the planes, the boats, the ports, all mobbed with people traveling. So travel is still strong. I think the U.S. consumer is someone you should never, if ever, doubt, Caroline. They're always there and spending.
So given, well, there is a strong consumer, but there are a lot of uncertainties still in this market. And, also, we didn't even really touch upon the uncertainties about what the Fed's going to do next. But the fact that, yes, we have seen some August weakness, but the Dow's still up almost 6%, NASDAQ up 30%, S&P up 16%, Russell up about 8% so far this year. Are you surprised that the market has been as resilient as it has been, given, Fitch saying it may have to downgrade following Moody's? I mean, it's not all good news out there.
No, it's not. And, Caroline, as a
Don't
trader,
be threatening me, Fitch.
I see everything through the prism of trading. And the markets like to go against the popular wave. And in the beginning half of the year, the market was generally, remember early in the year, the general consensus was, it's going to be a tough first half of the year, and then markets should get much better, the economy improve the second half of the year. Well, we spent the first half of the year going straight up. And now that the most sentiments out there are turning bullish, the market is starting to struggle. So I'm a big proponent
GameStop's coming down.
Watch what the popular view is. And the market loves to go the opposite way of the popular view. Not to mention if it gets economic data that backs that up or weakens the market. But the sentiment throughout the market, I'm a big fan of watching what the trends are and there's a overwhelmingly bullish feel going into the second half of this year, Caroline. And the market loves to disappoint people when the mass crowds get one direction or the other, Caroline.
Well, it's been very hard to be a bear this year, but it sounds like we need a few more bears in the marketplace to get more green arrows. All right, Kevin Hanks, we'll leave it there. Thank you so much for kicking off the show with us.
One trade, it's up.
Now let's take a look at a couple of stocks on the move today. For that, let's welcome in Renita Young, Senior Markets Correspondent here on the network. Renita, thanks for joining the show. We're going to kick things off by talking actually about two losers. Discover Financial shares sinking on news that its CEO resigned after the close yesterday. Fill us in on this story and the stock reaction.
One of the big things that's got this stock plummeting by 10% today is the fact that there was no specific rationale as to why the CEO decided to abruptly leave, and it was as of yesterday. So he's gone. right now, the company did appoint an interim CEO and president of the company, also president of the bank, who is one of the current directors, but he just gets
RAD
extra
down
jobs added onto his
4.6.
title because he will keep his title as director for a while as well. He will continue those duties. Now, meanwhile, Evercore ISI cut its price target on the company due to this abrupt departure, and it placed the company on its tactical underperform list. Now, the analyst says that since the CEO departure was very abrupt and the change could be related to Discover's recent regulatory and risk oversight issues, that I am sure we will hear a lot more about as this story develops. So Evercore ISI believes that the regulatory risk and then this uncertainty with management, also the expense implications, could pressure Discover shares going forward.
So that CEO shakeup definitely weighing on shares today, although we are seeing weakness across the financials on that Fitch warning. So, I was just taking a look. JP Morgan, Morgan Stanley, Citi, Goldman Sachs seeing weakness across the board there. Another big mover today is Sea Limited. It's absolutely sinking following earnings. What has investors so upset about these results?
Well, earnings and revenue came in worse than expected, and you can see that investors are not very happy about it at all. The outlook was not the best as well, but adjusted earnings came in below the consensus estimate at 54 cents a share. Revenue was also below consensus estimates at $3.1 billion. But total revenue is up 5.2% year over year, and total gross profit is up about 31% year over year. E-commerce revenue
All right, I got some calls for tomorrow.
year over year, and digital financial services revenue grew a staggering 53.4% year over year. But the core marketplace revenue is up by less than that. It's still up by a sizable amount, more than 37% year over year. However, the digital entertainment revenue plummeted 42% year over year, and bookings fell from last quarter, part of the bread and butter of the company. Quarterly active users, however, did manage to rise from a year ago. So truly a mixed report, but it was that revenue and earnings number that really has investors selling today.
Yeah, also they said they're going to boost investments in their core e-commerce business, which may eventually lead to losses, so could hit the bottom line. It seems to think that's weighing on results as well. Shares off about 29%.
Thanks guys for your likes today. Appreciate it.
Those results. Renita, thanks so much for breaking it all down for us.
Of course.
24.
All right, joining me now is Jay Hatfield,
24.
Chief Investment Officer at Infrastructure Capital Management. Jay, thanks so much for joining the show.
Caroline.
Good to see you. All right, so I was just chatting about
ETO
the markets
with
with
the
Kevin
highs.
Hanks at the top of the show. He said a few too many bulls maybe on the street. As soon as everybody turns bullish, the market starts to move
selling off
lower.
here.
I was taking a look at your notes. You're neutral on the market in the nearer term. So you're expecting kind of a range-bound S&P in the near term?
Yes, and for this time of year, that's actually somewhat bullish because normally you have very, very weak markets in the fall. If the leaves are falling, usually the stocks are falling as well. But we think that we'll get support around 4,300, and even right now with 4,450 range, there seems like an inflection point. So we're continuing to be bullish about inflation coming down fast, the Fed going on hold, the economy holding together. That's why we've been bullish all year. Our target's 4,500 to 5,000, but we just wanted to, make sure people understand, particularly retail investors, that the market does normally come off. If the companies aren't reporting earnings, then usually the random news is negative, like the potential Fitch downgrade. So we've seen that as soon as earnings season attenuated, the stock market got weak.
So 4,300,
GNS flushing down there.
Well, obviously we won't know till we know, but that's where we
Thinking
think there's
about closing
a
GNS
ton
today.
of investors that are on the sideline.
But
And they've
can't get
missed a
enough
lot of this
fidelity.
rally, and they have dry powder, and they're ready to come back in. So they're going to pick
Really want to see
entry
how it
points,
closes.
and we don't think it's going to be 10% down. We hit 4,600, so we don't think we're going to get 4,200. The 100-day moving average is right around 4,300. So that's our view. Certainly, we wouldn't be shocked though if we had 4,200, 4,100 during this down cycle in late August, September, and early October.
So could be some potential
Yeah, SPY's hitting right on the 50 moving average on the daily. That was a little gap down there to fill. Maybe fill gap and then rally to end of the week.
Well, if you're going to put new money to work, I mean, we like preferred stocks. They're less volatile than common stocks. They have great yields. A lot of them are going fixed to floating, which is fantastic in this market. Typically pretty low volatility. So, and we do think rates are close to peaking at this point. So if you want to hide out, cash is okay, but preferred stocks, you get paid a lot to wait, which should compensate you for the volatility during this downturn.
Any particular names or sectors that you like?
Yeah, so we like right now the floating, fixed to floating conversions. SCE, preferred H is converting to floating next March, and that's going to be yielding 9, de minimis credit risk because it's one of the largest utilities in the U.S., Southern California Edison. Lower fire risk than PG&E because it's in Southern California.
Yeah, I literally can't pull up
U.S. Bancorp,
the app either.
Name, they have a floating rate.
Sucks.
It's their Series A that's yielding over 8.5%. Even though they're going to be downgraded, they're still an A credit. So that we think those are conservative places to hang out. And particularly SCE next year, it's not impossible they call that. It's trading well below par. Par is the call. So you do have some capital appreciation upside, but you have to be patient. It's a 9-month trade, not a 9-day trade.
Okay, so broadening out the time frame just a little bit and looking past the fall and into year end, you said your S&P price target's around 45 to 5,000. What ultimately would push it as high as 5,000? What needs to happen for us to achieve, or for the S&P to achieve that?
Well, clearly it has to be ongoing and, in our opinion, appropriate enthusiasm about AI, because really our fair value estimate for the S&P based on next year's earnings of around 240 would only be 19 times, and that's contingent on rates coming down. So you could make a strong argument that 4,500 is actually too high, but I think that underestimates the power of this AI move. This is something I grew up in Silicon Valley. My mother told me about it 50 years ago. This is a huge development, not just technologically, but for society. And so it's appropriate to have some enthusiasm about that, some overvaluation, draw capital into that sector, accelerate the development. And that's why the U.S. always beats the rest of the world, is we have these efficient capital markets that attracts capital to where it's needed, where the best growth prospects are. So we think that's likely to occur after we get through this seasonally weak period, and we could rally as high as 5,000, but admittedly that's expensive. That's about 21 times, and arguably overvalued, but maybe not in the context of this AI boom.
AG still selling off.
If the Fed isn't done raising rates, if we see a hike, say in September, what could that mean for this market?
Well, it would be terrible if it's in mid-September. That would be like a good example of non-company news being bad. I think the Fed's base case plan, we do think that they're fundamentally flawed, but they've disclosed their plans pretty clearly, is to skip September and do November. We don't think they'll do November because the job market's weakening. If you really look under the hood, half of the job growth is in medical services, and that's much more of a secular trend, the aging of the U.S. versus cyclical. So we think the job market
it was good for me up until like an hour ago.
We don't even think they will raise. The real risk,
depends
if they
on where
do
you
raise,
are,
is brought up by the downgrade threat this morning. It's terrible for a lot of regional banks to have super high short-term rates and to have an inverted yield curve. So we're hopeful that they'll take that into consideration. But really, this Fed needs to have a top-to-bottom review, just like the Bank of England is doing with Ben Bernanke, because they really, really missed the cycle going into it. High inflation, they don't understand that inflation's low now. They're stuck in their Phillips curve situation. So they could raise one more time, but I think it's worse for the banking system than it is for the overall stock market.
All right, we have to leave it there, but really appreciate your insights and your picks, Jay
I think I might want to leave
Infrastructure
Fidelity.
Capital Management. Thanks so much.
No reason to be in there.
For having me on.
Coming up, we'll dive into the retail space ahead of Target earnings tomorrow morning. Our next guest will give us a bearish trade setup for Target and tell us why he's leaning that way next on Market on Close. We'll be right back.
I said this last time they were down for like 2 days. Yeah, I might do an account transfer. Sometimes I get a representative on TD on chat. I don't know how I find it. I know they have it, it's just hard to find. Spine's coming down here. See if we get a bounce on the low or fleshy flesh. We get a flush here. This breaks. This trend. This week's going to be pretty red. That gap fill, I think, will be a thing of the past. We get a serious drop. Today's already down 1%. It's Tuesday. Yeah, I'm transferring out of Fidelity. This is stupid. They're down way too much. GME's coming down.
home goods and clothing category, which if we look at the data for Q2, we really have seen a consumer that's been extremely selective, spending much more so on services rather than goods. So really, this is really a weak spot for Target this particular quarter in terms of how consumers have been spending in this past quarter. And the boycott certainly doesn't help it. Target is currently on target to actually have its first revenue decline in the past 4 years or so. So not a great picture going into earnings season. And I think that, whether you look at, Amazon that's reported strong earnings here this particular quarter, maybe taking a little bit of market share here away from Target in that e-commerce space. So just all around, not a particularly great quarter here for Target after, what hasn't been a particularly strong consumer spending quarter. And that's really the risk that I see here, the downside here for Target.
Okay, we'll get to your trade in just a second, but your expectations obviously pretty low for Target when it reports tomorrow morning. But if you do take a look at the share price, as you showed on the chart, it is a stock that's already down about 15% year to date, as opposed to
test
Walmart,
the low of the day.
Positive, up double digits on the year. Would you say maybe the bar is low enough that even just a meet might mean the stock could pop, or no?
It absolutely has that potential, and that is a risk with this particular trade. And that's typically why with trades like this, I do want to use options to play this, to reduce the amount of risk that I take, so that if you do get that pop, I'm limiting the amount of risk that I take on a bearish exposure here. But you do have a very good point. Target is trading at a relatively, I would say, reasonable valuation. It really comes down to guidance that they provide here for the rest of the year that could, give us a sense for whether this moves or not.
New low of the day there on
SPY. I will say is that, this has been the earnings that moved higher in terms of pricing. So if you're coming in line, my expectation is that the stock will likely still continue
too soon
to
on my
decline.
calls.
Look at Home Depot.
Too soon,
Today,
Junior.
stock hasn't moved. So this is really a good trading opportunity, I think, for stocks like Target, where I expect there is going to be some softness in terms of both guidance and where they end up this
There's
particular
some
quarter.
flushing.
Okay, so let's get to that bearish
1%.
trade. Tell us about the setup.
Yeah, so right now implied volatilities are high for both Target as well as the overall market, with VIX currently now at 16 handle. So I'm inclined to be a seller here going into the earnings announcement. I'm looking at going out to the September 29th weekly option.
We
That's
broke
about
through
45 days from expiration.
Broke through that
Earlier
support
today,
there.
I was looking at selling the 129-141 call spread for about $4.20.
Got
But
one
the
more
stock's down to
support
about
down
the
here.
126 level. So the stock's
Go on
down
this
nearly
channel.
$3 since we looked at this trade earlier today. So I would adjust this down by about $3. So I'd be looking at roughly the 126, 138, 139 strike price. You're still looking at roughly about $4.20 for that type of credit spread. And this type of trade allows you to be profitable with a little bit of room to the upside. Even if the stock were to stay where it is or even move a little bit higher, you can still be profitable. And that's kind of the benefit of trading these types of credit spreads, because after you enter this particular trade, one of three things can happen. The stock can decline, the stock can stay where it is, and the stock can rise. And in 2 out of those 3 scenarios, this strategy is profitable. So if the stock declines, you'll be profitable. If the stock stays exactly where it is, you'll be profitable. Only if the stock rallies significantly above that 139 level, which is quite a bit above where the stock's trading. We're talking about $13-14 above where the stock's trading. Do you have risk, or rather substantial risk on this particular trade? But even then, your risk is limited to roughly twice the premium that you're collecting on this particular trade, which is roughly about $420 in premium per contract. So this is the type of trade structure that I like going into earnings, because you never know how the stock is going to report. You also don't know how the stock's going to react to that report. But in 2 out of 3 possible scenarios, you'll be profitable. And that's kind of why I like taking these types of option selling strategies going into an earnings announcement like this.
Tony, I know I didn't ask you to bring a trade for Walmart, but I'm just curious how a trade for Walmart would look compared to this bearish Target trade, given the fact that it's not as exposed to or not as reliant on home goods and clothing, but it's not a beneficiary of the shift from goods to services either.
Yeah, so I think Walmart will likely be much more similar to the Home Depot report that we saw here today, largely in line, perhaps a little bit better than expected, and not a huge reaction from the stock itself. And I think the trade structure for those types of opportunities is the exact same one that I presented here on Target. It's just that in this particular example, because implied volatilities on Walmart are not as high and expectations are not as wide in Walmart, you're just going to collect less premium on that particular trade. But the trade
That gap's
structure,
filled now.
I would still use the same one, selling a call credit spread. My expectation is that if Walmart comes in line or even slightly better than expected, the stock won't make a big move. It might likely just stay where it is, and selling a call spread like this allows you to take advantage of that. But if, let's say, you have a more bullish tilt to Walmart, then I would sell a put spread. You have very similar risk to reward ratio, but more so to the upside rather than to the downside. So either one of those trade structures, I think, makes sense for Walmart.
All right, we really appreciate that. Should note Walmart not having a big move today, only off about
GME's
0.4% versus Target's 2.2% decline. Tony Zhang of Options Play, thanks so much for gearing us up for Target. Coming up next, it's Options Corner. Tom White will join us to take a look at some unusual options activity in the market today. He'll be taking a look at trades in Capital One, Citigroup, and Amazon. Market on close. We'll be right back.
Well, we're still in the channel. Wasn't broken out of this channel. If you get a gap down to bring us out of it, then a rally back up to test his resistance. Or if this is the low, we bounce back up into the top of the range. Fidelity. Yeah, I got transfer. Boom. Fidelity's worse than Robinhood, as far as that goes. I don't think they do payment for order flow, but I don't know. Kind of like that. Removing buy sell buttons on everything. On your whole account. Market's starting to flush. You want to pull out? Sorry. Technical difficulties. just chatted with them. They said they can't sell it. They have to call in. Site-wide outages. Login's a very long wait. Trying it in an hour. Yep. Okay.
Caroline, the last time that we saw levels of Capital One like this, it was
The
back
push
in
market,
May.
yep.
This stock was trading around $84 a share, so it does have that ability to go much lower than the current share price in here, but we'll have to wait and see. But somebody taking a bear stance here, kind of going against Warren Buffett and his boys at Berkshire Hathaway.
Not giving a boost to Capital One, Warren Buffett isn't, but also not giving a boost to Occidental. Shares off 2.5%. Yeah. Apple, their biggest holding, shares off 1.2% today. So no Buffett magic today. But going back to financial sector, you saw Citigroup, where someone was actually taking a bullish stance, not helping shares today. They're off about 2% today. But tell us about that.
Yeah, this one has been under pressure all year. It's kind of underperformed as far as the four large money center banks, including Bank of America, which is down about 9% so far this year. But JP Morgan, Wells Fargo, both positive on the year. So this one's definitely underperformed in that sector. If you take a look at it, it's off about 4% so far this year. You see that. It's been a really choppy trade here. You can look at the chart. Over the last basically 52 weeks. This stock was trading over $84 just about 2.5 years ago. But Fitch Ratings analysts warn that the U.S. banking industry has inched closer to another source of turbulence. That was the big note out this morning out of the analyst Chris Wolf from Fitch Ratings. Now, this is on top of what Moody's came out and said about the regional banks last week. So quite a bit of volatility and chop here in the banking sector and the financials. Besides energy, it's the second leading sector on the downside as far as S&P goes. But somebody may be taking a stab here where they think this stock's going to rebound, but giving themselves a little bit of duration. We saw a big buyer out in the September 29th weekly series in here. So about 45 days till expiration on this one at the end of September, closing out the quarter. Trader bought 10,000 of the 46 strike calls. Debit of only 64 cents. There's not a lot of option premium on upside out of the money calls in Citigroup. But that takes that break even, Caroline, up to 46.64 over the next 45 days. That's just about 7.5% above the current share price in here. So somebody kind of going against the grain here, and the Fitch potential turmoil for some of these banking sector stocks that might get a downgrade as far as ratings go in the near future if this analyst has his way. But yeah, somebody definitely taking an upward bias here, but giving themselves some duration, maybe expecting, because it's at the end of September, that there might be some rebalancing goes as far as portfolios, but looking definitely for a bump in this stock over the next month and a half.
Potential downgrade from Fitch definitely weighing on bank shares today, including
SPY flagging down here.
All right, lastly, it's the retail giant
Bouncer
Amazon,
on
where
GNS.
someone's getting long the shares. They're off 2% today, giving up some of their August
Yeah,
gains.
like one
the
more
only
little push,
one of
maybe.
the Magnificent Seven in the green in August, but not today.
Yeah, Nicole, and I think somebody's probably trying to take advantage of this small pullback that we're seeing in Amazon. I mean, the shares are still up, 64%? So far in 2023,
Yeah,
so it's
I
had
think
a
I have
good
enough
run,
accounts, so I
had
kind of
a
want to
really
get rid of
good,
one.
Earnings event just a couple of weeks ago. Their Prime Day beat estimates, over
Believe it or
12
not,
billion
it
spent.
doesn't.
They added
You
another
don't make more
Prime
money if
Day
you have
that's
more
going to come in
accounts.
October
It's really
also.
weird.
So probably trying to take advantage of pre-holiday shopping for this one. Now, if you looked at some of the 13F filings that came out overnight.
I could
Amazon
consolidate.
was in the mix on a couple of these. Lone Pine came
I'll
out,
probably move it to
increased their
TD.
stake in that.
I could even move it
Point,
to Webull.
and also
I don't really want.
Appaloosa increased
I don't really
their
want
stakes
long-term
in
in
Amazon.
Webull.
So betting on this
I moved to
recovery that we've
TD.
seen
I
so
like
far
TD.
this year, that's going to continue to expand.
Like E-Trade all right also.
But we'll have to wait and see. We've got a lot of retail earnings this
I
week too.
think
that
Thinkorswim
might
is a
dent the
better
sector. But we did see some call buyers taking
brokerage
advantage
as far
of
as
this pullback today.
if I ever want to get into the desktop,
to me as far as
their
unusual
desktop
option
app.
activity on this one, they went out in duration. They went out to the November monthly cycle. So you'll probably capture that October Prime Day that they're going to have, that sales, and you'll probably start capturing maybe some of the holiday shopping season. But they bought deep in the money calls here. They used the 120 strike call. They bought over 12,000 of those, but they paid a hefty debit for these because they're deep in the money. They paid $22.35 for 12,000 of these, so that break even of $142.35 over the next 94 days, that's only about 3% above the current share price in there. So you don't need that big drastic move, but you're outlaying a lot of capital. You're paying a high debit for each one of these calls. Now, the calls are deep in the money.
Literally is doing the opposite of yesterday.
They've got about an 80
bear flag,
delta, so
break
that,
out of the bear flag.
reacts more like the stock the higher the delta is.
Bull flag, break out of the
taking
bull flag.
an
Yesterday was a little
outlook
later,
here that
like
we're gonna
right
see
in the
a
close.
rebound in Amazon while still giving themselves over 3 months until expiration. So bullish
1 1/4
flows here
down.
in
It's not a small
Amazon
day on
today,
SPY.
despite the little sell-off that we've seen.
All right, Tom White, appreciate you breaking down those options trades for us. And the fact that you called it not once but twice, I consider the highest compliment. Thanks so much.
My apologies.
Coming up, Jenny Horn will give us an update on cannabis stocks as an ETF will close due to lack of interest in the group. Market
Meme.
on close, we'll be right back.
Meme stocks. I think that meme ticker is going. Oh, a cannabis one. I read something about the meme stock, or maybe just down a bunch. Maybe it's closing. I don't know. Futures there for treasuries. I don't know if I'll ever invest in treasuries. I already have an E-Trade. I guess it's not. Yeah, it's not about getting new ones. It's about which one to consolidate with. I don't think I want a new one. If I was to get a new one, I would probably get Tastyworks. I'll kick us in the nuts tomorrow. That's a lot of nuts. BB&T has earnings? Oh no, they had earnings. What? Did they really though? Ah, I'm in. I won the money. The money is mine. I won the money. I won the money. The money is... I win the money. Working. $15 minutes. See if you get a SPY bounce. Back to that breakout. Up's down 4.7.
It's time for a developing story.
Jenny
Horn joins us, and we're taking a look at cannabis stocks where a certain ETF will be no more. Give us the details, Jenny.
The tails.
Yeah, so Caroline, first of all, I need to check on old man Tom White to make sure that he's doing okay because I'm a little bit concerned. I would not mistake you. You are Caroline, of course.
That
but
is so
story
rude,
today
Jenny.
is that Poseidon Dynamic Cannabis ETF, of course, is shuttering. Now, this name has lost around 74% of its value
new low
since
there.
it was founded. It's down about 36% now on the
All
year.
right.
The closure, though, is the latest blow into
See if we
the
get a bounce in this area.
semi-legal cannabis space that is yet to was really awaiting some of this critical funding as a result of then being legalized at a federal level. So Advisor Shares, which is the largest cannabis fund manager, did say Poseidon Dynamic Cannabis ETF will see its final day of trading on August 25th. It will liquidate its assets, then be paying its shareholders on September 1st. One of the co-founders of the fund did say they were not immune to some of these broader macroeconomic trends, and the dramatic shift in investor sentiment has impacted the cannabis industry as a whole. Now, this name really took off during the pandemic when we saw a heightened interest in some of these pot stocks, and it's just not been able to recover. Now, while nearly half of the U.S. states have legalized the recreational use of cannabis by adults, it is yet to, again, meet that federal level, which is what's crippling this industry, really. Poseidon is the latest casualty in the industry that is strained by market forces and economic policy. Last month, a $2 billion merger between cannabis operators Cresco Labs and Columbia Care disintegrated in a move that, again, further alienates the cannabis industry from big banking. We did also get reports from
GNS.
Bloomberg last week that MasterCard actually sent a cease and desist letters to banks and payment processors that facilitated debt card purchases of pot. Now, a MasterCard spokesperson said this is in accordance with their policies, but actually this same co-founder of the Poseidon Dynamic Cannabis ETF said that right now this is a painful reminder of the current status of cannabis as a Schedule I substance under federal law, putting it actually in the same bucket as like heroin. So this is really interesting to see now the feedback from those, of course, that are behind a lot of these ETFs. This space, and when you look at some of these individual stock names, they've just been beaten down so badly and have yet to recover. And it's been more of like a 3-5 year long story. But I think all things are riding on actually the federal legalization. So interesting story, and it
didn't break through
see what
support, so that's good.
Other cannabis
but
ETFs.
on the shorter term here, it's
Interesting. We'll keep an
looking
eye
like
on
it's
that.
rolling
Jenny
over
Horn,
pretty good.
thanks so much, and thanks for the laugh.
Maybe look for a gap fill. Maybe a bounce on this trend
Welcome
line.
in Dan Deming, managing partner at KKM Financial.
The
Dan,
daily
thanks
candle's
so much
not
for joining
super
us.
bullish either.
Hey, Caroline.
Inverted hammer.
So we kicked things off at yes, thank you for that. We kicked things off at the top of the show
RSI
by
ticking
talking
down.
about some of the weakness that we're seeing in China, but the data certainly not even really showing an uneven economic recovery now post-COVID. It's pretty sluggish. What do you make of that on top of the concerns that it has in the real estate sector, which houses the majority of household
Best time
wealth
of day to sell,
as
but
well? Is there potential spillover from this China weakness?
well,
Yeah, there's always a potential for that, Caroline. I believe that, from a global perspective, it could be a harbinger for some economic slowing, not only in that region, but from a global perspective.
AMC bouncing on
At
VWAP.
this stage, I don't think it's too significant. You're seeing it being priced in today, certainly when you look at the price action in commodities, and particularly in the energy space. But, that's coming off of some multi-month highs just in the previous session. So, I don't think it's too significant at this point, particularly when you look at what's going on here in the U.S. and even Europe to some extent with, retail sales continuing to show pretty good growth. And, the one concern, I guess, in that data point this morning was the prices component, both in exports and imports, higher than expected. But overall, we continue to see pretty decent economic activity here in the U.S. Some moderation to a little bit better than expected economic activity in Europe and some of the other global areas. So China in and of itself, it could be a problem moving forward if we see it to start to spread and we see it really impacting some of the other sectors of the market. But at this point, I think it's just a reaction that we're seeing play out today.
Okay, so let's talk about the crude oil reaction, because it is weighing on oil. Taking a look, it's trading around 81 right now, off almost 2%. Can oil continue its run
kept flushing. It's down 30% now.
Weak?
Well, that theme's been there for quite a while, so I would say yes, unless we see some significant extended weakness, because that theme in the market has been there for the last several months. I mean, it's not a surprise that China continues to struggle in trying to maintain and restart, I should say, economic activity. And they've taken some measures, and we did get some positive reaction initially, but now these data points continue to show that it's going to be uneven and potentially it's going to take longer than anticipated. So I would say that, if China can somehow stabilize and start to show that there's some stability and potentially a light at the end of the tunnel, that we could certainly see energy prices continue to move higher. Now, one thing I do want to point out here, Caroline, is interesting dynamic yesterday with WTI and RBOB. When RBOB traded at 14-month highs yesterday, even though WTI traded at about 9-month highs. So you are seeing it play out in certain parts of the energy market where we're seeing a higher price action and relative price action, particularly in the gasoline area relative to the crude space. And that's something that customers here in the U.S. are feeling right now.
Not what the Fed necessarily wants as they're trying to rein in inflation. All right, just want to finally ask you about the dollar, gold, seeing
This is
weakness
way
in
lower
gold
than, like,
today. Dollar essentially
COVID
flat.
lows.
What stands out to you there?
Is it COVID? COVID?
Well, I think gold's just a combination of interest rates continuing to move to multi-month highs here. The 10-year pushed up to 428 basis points today. That's the highest level since November. So I think that that's a headwind for gold short term. The dollar, I think, is being viewed as a safe haven play right now with some of the interest rate activity as well as economic activity from a global perspective. So I think the dollar's benefiting from that short term. Plus the selling market. Selling in the stock market. Boy, if I could speak today. The selling
what are
in the
you
equity markets
getting
right now with some of the major
annualized
averages
on
breaking through the 50-day moving
right
averages is another concern where I think the dollar's benefiting. You're seeing it impact the commodities in a negative sense.
All right, Dan Deming, KKM Financial.
That's
Always
right,
a
Vegas
pleasure. Thanks
vacation.
so much.
All right, thanks, Caroline.
10 minutes Fugazi, there it is. Danced around, not a big
about
bounce.
10 minutes away from the closing bell. Let's wrap up today's
Only
market action
5%.
with the team at Charles Schwab
Get some
and
puts
get their
there.
take on today's action, what
Jack.
you should be watching for. Market on close. We'll be right back. Stay with us.
I think it'll consolidate or could give up some. That's why it closed.
Let's walk through how to analyze
I don't
a
know.
company's
I mean,
financials
it's at
on
a spot
Thinkorswim.
that's like so.
To get started, go
It's
to
had
the
such a crazy
Analyze
rally,
tab
so.
and select
Kind of let it go and let it consolidate some more. Maybe pick it up a little cheaper. I don't necessarily think the rally's over, but it could be. It could all start with just some flattening out, and then it's actually the top. Similar to how RAD is looking. Looked like it was flattening out, consolidating, and then kind of broke through that flag that day. And that just started the downtrend. So GNS hasn't done that yet. Keeps bouncing on that level, so that's good. 135 it hit today again. But I think we could see kind of some gap fill. A little double top here. MACD flipped over, you've got right into the 9 moving average. Bearish MACD. Haven't really had like a pullback at all in this rally. A significant one. A 50% would be $1.11, somewhere around there. Finally, Auto Lords comfy. What? What about Lords? 5.2%. Week to month out. Nice. You could put some of that in HE. Almost 10% divvy now. I guess IEP is probably a pretty good divvy dip buy if you believe in it. Maybe it's a little too high, 16%. We'll bounce around AMC. Eyes bouncing a bit. We got a 5-minute finger slap coming. Barbecue 22 cents. 4%. ETOO at the high still. Yeah, that's a good idea, Poison. I did that on Friday. Or no, I sold it all on Friday. And then I bought back in just with my profits. What was that? Yeah, here. Bought back in with my profits and then bought back in with more here. So I'm not up a whole lot on it. Pretty much where I bought back in. So, which is fine. In case it did keep ripping. I mean, it did make a nice move still, I suppose, but there's your SPY. Here's your SPY. 5-finger slap on SPY. I am not bipolar. Keep telling yourself that, Lords. Every day.
Because that ship already sailed for some of those aforementioned segments, but any hit that is yet to come for services in the labor market could potentially be offset by recovery, resilience, or improvement in some of those other areas. So I just think you have to fine-tooth comb this cycle a bit more than usual just because of the unique nature of the pandemic.
Cooper, I'm hearing more and more about this no landing scenario. What would the implications of that be?
You know, I think that I agree with Lizanne, obviously, that I think that we're probably in a rolling recession. And I think that this is, again, a unique nature given the pandemic of an economic cycle. So I think that kind of the case for soft landing, no landing, hard landing, I mean, I wouldn't necessarily say try to pick out one or the other, because I think that it is very much a nuanced in the market right now. Like Lizanne was saying, if you think back to kind of those books that maybe we read when we were children, it's very much the fixed income market is telling you to pick your own story. So I can point to a metric of, say, the inverted yield curve that's potentially pointing to the possibility of a recession. However, if I look at the high-yield bond spreads are the lowest that they've been in a year. They're pointing to a potential of no recession. So I think that trying to nuance it of saying, are we going to get a hard landing, soft landing, no landing, etc., isn't the correct way to look at it. I think Lizanne is correct in saying, kind of, given the unique nature coming out of COVID, we have to fine-tooth comb it a little bit more in the fixed income market and also in the equity market, as you mentioned.
And, you know, I'll add on to what Cooper said. I think the thing about a no landing scenario is there's
GNS
unlikely
gap
a lot of longevity to that perspective, or at least as it relates to the current expectation of 4 to 5 rate cuts.
Another one down
year.
at 60.
A no landing scenario where you see no weakness in the economy, no weakness in the labor market, even if disinflation continues,
if it doesn't hold this trend,
suggests that
I think
the
rally's
Fed
probably over for a while,
stays in
at
pause
least.
mode
this
longer,
rally is.
or maybe even tighter longer, which then eventually means there's no such thing as a no landing.
Okay. All right. We have to leave it there. Lizanne Saunders, Cooper Howard, both from the Schwab Center for Financial Research. I always appreciate your
bouncing up
insights.
there.
Thanks so much.
Defending that
Bells are
range.
about to ring. Up next, it's our closers panel. We'll look at some
A
of the
longer
top
time
themes
frame.
of the day and what you should be watching for
Right on
tomorrow.
cue.
Market on close. We'll be right back.
So still in the range. Bears didn't break it out.
Let's walk through charts.
Version of suck. Excuse me. Well, did it. Green on my small account challenge. 0.97%. So tiny green day. Overtraded too much in the morning. But green is green. Not a whole lot of setups I liked. The morning setup was nice. this long was fine. It's just a pretty tight range. The short was kind of fine, just a lot of chop in time between there. I was out of trades though after this short, so probably fair enough, as this is a trap in here. This is hard. So maybe doing like credit spreads or something in the future. It looks like there's a range coming, like call credit spreads at VWAP and put credit spreads near the low. Just letting the theta burn on them. There's the bell. Didn't do anything on the... Didn't do anything actually, really. Just did stuff in the theta farm today. Nothing on my options trades other than the daily SPY stuff. And yeah, just closed out a GNS, I guess. That was one thing I did. But yeah, that's what I got, guys. Thanks so much for the support. Thanks for hanging out with me today. Sorry, I'm kind of absent a little bit just because I'm still sick and it's hard to talk and clearing out my sinuses and resting, and yeah. Oh, fine. Thanks for liking it, Lords. 122%. Well done, sir. Yeah, I feel like, well, this morning, yeah, so a couple errors today. One was I overtraded too much too early, and then during the morning when I could have had pretty good percentage moves, I was accidentally trading tomorrow's contracts. So with that, I was doing less contracts, and of course they weren't moving nearly as much. I didn't catch it until like here. I was like, oh wait, that was kind of weird. But other than that, I guess it was just much trading. But yeah, thanks guys, appreciate the support. We'll see you on Discord and in the chat, in the description. Our Twitter is also in the description. Thanks Bubba, thanks Tess Beastie for the rest of your day too. Thanks Kevin, thanks Lords, thank you Christopher and Poison, thanks Dink, Jack and Kevin. You guys have a good rest of your day. You ride it down. Thanks Kitty, have a good night to you as well. More dry power for president. More dry powder for tomorrow, that's right. Yep, little by little. Ace for president. Yeah, Ace has been MIA lately. What's he doing, dude? Barbecue's down 4. Yeah, still in this downtrend, so that's why I closed back out. I just false breakout here. Now I want to see it break this level. So basically what I'm forcing it to do. And might see 1750, 18 area. Let's look at GME too. It also came down 3% today, so retested that low. Starting to show a little support there. We'll see though. I think could keep coming down. Depends on the market. Market might bounce the rest of the week, and you might see GME kind of trade up in this area, closer to 20. The market does come down. I mean, I think it'll come down and hit 18. But even if it does trade up here, I think it'll still come down and hit $18 if we don't break above this resistance. So kind of the same thing with the SPY, honestly. We're in this channel. Bounced off there end of day today, so that's bullish for the most part. Just have to break out of the upper resistance on this channel. We're going to see a move back up to kind of this cup, 453, maybe even this whole gap fill up here, 456. Could still happen. Break to the downside. I think we've got room to go, 437. Or maybe seeing much of a bounce. So yeah, Legend has it, he's always here. Yeah, come to Discord, Bubba. Love to have you, man. Pakistani trader cost me 30k. What the heck? Okay. Don't spend any money on Discord unless it's to donate to yours truly, Happy Money. I won't ever ask for donation though. Thanks guys, we'll see you. Peace out.